No.
Are you actually looking for intellectual consistency?
Just asking. Just asking.
Have you had a teenager?
Just asking.
Anyway, I'm not that anyone's watching, but I'm just saying, you know, that...
Oh, no one's watching, Bramo. No, it's just live TV.
All right, so, but there is this issue of, you know, Amazon and some of the competing challenges at a time when they have raised the prices for consumers, merchants on their platform.
Thank you, Lisa. Appreciate it.
Anytime.
Third story, Apple, the market cap topping $3 trillion for the first time in several months. The iPhone maker getting a boost after Chinese assembler Foxconn reported better than expected sales in the fourth quarter. Apple has gained 16% from the October low and is up nearly 50% on the year. I mean, Lisa, there are fundamentals and there's price action, but if you look at the overall sales trend for the iPhone, it hasn't been great, and yet we're putting up gains like that.
Honestly, if you just go into any store, the fact that people are lined up to pay $1,000, $2,000 a pop at whatever they end up purchasing gives you a sense of just what a cash cow this is. And again, you start talking about a market call. How do you have a market call without having an Apple call? And if that's the case, can it just diverge that much more from the underlying economy?
There we go. Apple, rip, roar, and rally.
I know. Tom would be saying,
rip, roar, and rally.
Hey, just get it done.
You've got to participate. That's what TK was saying. Then at the same time, totally inconsistent, he would turn around and say, triple leverage cash. Yeah, okay, try and make sense of that. Let's talk about credit. The competition growing between traditional banks and private credit. Apollo Asset Management's Jim Zauter in conversation with us yesterday, defending private markets and calling it a $40 trillion opportunity.
We think the definition of private capital and private credit is around a 40 trillion number. And that would consist of, you know, solar finance, inventory finance, trade finance, franchise finance, along with a lot of this corporate lending and investment grade privates that a lot of banks used to hold large chunks on their balance sheet. But again, in their search for ROE and appropriate returns, they're not the right place to hold that.
Joining us now to have this conversation, Amanda Lynham, Head of Macro Credit Research at BlackRock. Amanda, good morning.
Good morning. Thank you both for having me.
How much money is shifting to private markets?
So our forecast calls for that asset class to grow from $1.6 trillion globally to $3.5 trillion by the end of 2028. So that implies a pretty significant continued growth pattern through the next 5 years. There are really four drivers behind that. The increase in the addressable market is one of them, but it's really investors looking for diversification, borrowers looking for certainty of execution, structural shifts in the public markets, which are now serving larger and larger borrowers, so that renders small middle market debt deals illiquid. And then fourth is the opportunity for banks to partner with non-banks, and also just given the well-telegraphed contraction in bank lending and tightening of bank lending standards to really fuel that growth. And so that's our forecast.
Was that a really nice way of saying debanking, that basically private credit is stealing banks' lunch?
I watched all of your great coverage yesterday, and I did see the debanking dialogue. I actually think I agree with the comments that banks will remain at the center of the lending universe. That said, I think the important takeaway is that as private credit has become sizable and scalable in its own right, it can now compete against other parts of the market where it wasn't historically. And so what we've actually seen are some companies with demonstrated access to the public markets choosing to refinance in the private markets. I think there's an opportunity for banks to partner with non-banks in terms of in an environment where capital and liquidity rules may change, to partner and maybe move some of that lending into other parts of the non-bank system. Doesn't mean that the risk transfer is a negative. It just means that capital is being reallocated, just like it did after the financial crisis.
So there is this sort of larger question when you say banks will still be the center of the lending universe. It raises this question about what that means. They'll be the center in terms of maybe organizing some of these transactions, but not necessarily the center of profits, not necessarily the center of deploying risk and then getting that outsized return for some of these private loans. Is that what we're seeing, that they're going to be the center of sort of some of the transactional aspects, but that private credit firms are going to really get the upside from these loans that banks used to capture?
I mean, I think from the side of the banking relationship, they really have a lot of the client relationships, a lot of the underwriting expertise. But in an environment where risk-weighted assets are going up, does it make sense to hold all of that capital on the bank balance sheet, or is there a more capital-efficient way to do it? I think that's really the shift that we're seeing. Now, some of these factors have been in place for a really long time. Going back to the financial crisis, after Dodd-Frank was enacted, the public syndicated leveraged loan markets grew because banks didn't want to keep those loans on their balance sheet. Instead, they syndicated them out to a wide range of investors. That's how the public debt markets have been growing for so long. So I think that's just, and it's another sort of iteration of this capital allocation that's shifting in response to the regional banking disruption in March, in response to the potential rules for Basel III Endgame, and I think it's probably a longer-term shift. By the way, I would say, you know, our $3.5 trillion forecast, it assumes a 15% compound annual growth rate. That's actually below the growth rate that we've seen over the past 5 years, and it's consistent with the growth rate over the past decade. So it sounds large, but it's actually a continuation of the trend that's already been in place.
Let's talk about big moves over the last month. Credit spreads so much tighter on high yield. I think 367 right now. I just wonder, from your perspective, still up in quality, and what do you make of this move?
So, I mean, I think the move, it's consistent with this kind of year-end rally that has been fueled by pretty favorable technicals. We've seen issuance pick up, but not to a significant extent that it's interfering with that tightening. From our perspective, yes, up in quality still makes a lot of sense for this really important reason. Most of the issuance in 2023, and I'm talking about the LevFin market, has been up in quality within that market. So double Bs and high single Bs. The low end of the quality spectrum, so triple Cs and low single Bs, has really been untested. There's been a lot of talk about rate cuts. That's not really our base case in the first half, but even if we do get a few modest rate cuts, just to put that in perspective, the implied refinancing cost on average for triple Cs is above 600 basis points. For the distressed universe, it's above 1,400 basis points. So this low end of the quality spectrum, even if we get some rate relief, they're still going to be refinancing into a much higher cost of capital regime.
How long can Goldilocks last then?
I think it's the title of our 1Q outlook was a widening divide, and I really think it speaks to the dispersion that's evident under the surface in a lot of these markets. So for Goldilocks investment grade, Goldilocks high quality, high yield, they're in a pretty good spot, especially if we can achieve the soft landing. If you're a triple C rated credit that has refinancing to do, and you're looking at your current coupon and then the 600 basis points that it may cost you to refinance in today's market or more, much different story. It's part of the reason why we expect defaults to continue to march higher through the first half of next year. It's not a spike, not a significant increase, but I don't think, we ask a lot, have we seen the last of this transition to a higher cost of capital? I don't believe that we have.
If you are just joining us, equities priced as follows. The scores look like this: positive by about 0.2% on the S&P 500. Let's talk about your rate cut call just briefly to wrap it up, Amanda. We've heard from Deutsche Bank this morning, 150 on the ECB next year. They're looking for 175 basis points of cuts from the Federal Reserve next year. What's your call? Why is it different?
So the best case outcome would be that central banks are cutting rates to get ahead of a potential slowdown and really responding to the decline in inflation. I think the bar for that is very high because, one, I think central banks have told us that they don't want to cut prematurely for fear that inflation would reaccelerate. And then also, if you look at wage inflation, it's moving down, but it's still pretty elevated, especially in Europe and in the UK. So that's not our base case. I think what I would just flag as an observation is that if we do get rate cuts in response to a growth downturn, spreads are likely much wider in that scenario. And so as it relates to corporate credit, it really comes down to what is the all-in cost of capital, and wider spreads, even if you have lower rates, is still the same outcome of a higher cost of capital. I think we feel pretty confident from our team saying rate cuts in the first half are unlikely. We'll see what the second half brings, but that kind of Goldilocks, as you refer to it, scenario of we're just cutting to kind of get ahead of a growth downturn, that would be great, but I'm not sure that's our base case at the moment.
Reality or a fairy tale? Amanda, thank you. Amanda Liner of BlackRock. We talked about that a lot. Not all rate cuts are created equally. They're just not.
Yeah.
Get a downturn in economic growth and they're cutting rates because of that. Different outcome for markets. From a beautiful New York, this is Bloomberg.
What do you worry most about your economy in Greece? And when you look at tourism, it's booming, but it also means some of the islands are overcrowded.
Exactly.
Is there something that you can do about that?
Thank you for asking this question, because I want to make sure that, in 5 years from now, we will not have sacrificed, the beauty of our sort of natural environment at the interest of a very rapid growth. So that's why I'm really focusing on sustainable growth. That's why I will always push for quality over quantity. very strict in terms of standards. We are actually looking at our local and regional sort of planning legislation across the country to make sure that we know exactly what we can build and where we can build it. There are parts of Greece which have reached saturation point, and if we have to place restrictions, we will, in order to protect, especially islands, which are more sensitive.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
I think the world is debanking. And I say it this way. Every economy, every regulatory scheme, credit is tied to GDP. And regulators have only two choices as to where credit comes from. It can come from the banking system, or it can come from the investment marketplace. There's no third choice. And everyone around the globe has made a different decision. But if you look at the trend, with the exception of China, everywhere in the world, regulators are favoring investors over banks.
Is that going to change anytime soon? That was the Apollo CEO, Mark Rowan, saying he thinks the world is debanking. The CEOs of Wall Street today, of the biggest banks on Capitol Hill, this morning for their annual testimony before the Senate Banking Committee. Executives expecting further questioning over regulation, including higher capital requirements. Jamie Dimon at JP Morgan, David Solomon at Goldman Sachs, James Fraser at Citi, and outgoing CEO James Gorman at Morgan Stanley among the 8 banking leaders scheduled to appear. Bloomberg's Sri Natarajan joins us now for more. Sri, let's talk about it. There's going to be 2 issues here. One is going to be financing the economy. Let's talk about the number 1 issue as it pertains to that. The risk transferring from public markets to private markets. What's the big push from bank CEOs going to be today?
The big worry, at least what they have, is declining profits going forward. They do not see a scenario with the current regulatory climate where they can sell a great growth picture for themselves, which is why you have this unique situation where a hearing that is designed as a platform to hold the big banks accountable is instead going to turn into one where they're going to air their own complaints. The analogy I've been using is, think about it as 2 bickering parents. You have one parent, the regulators to the banks, trying to impose discipline, trying to put in place strict capital rules. So what are the bank CEOs doing? They're going to the other parent and trying to find a sympathetic ear. They're obviously going to play to that base. They're going to say that the consumers are going to suffer because of this. Higher airfares, no mortgages available, you can't make more loans. The reality is, at the end of the day, their profits will be hit. The Fed is batting back the idea that this will have some sort of outsized impact on the economy. They're saying, yes, your profits may not grow that much, but that's fine. In the last decade, the 6 biggest banks had $1 trillion in profits. So that is the trade-off here, and that's the fight that will play out for a while.
Any reason the direction of policy is going to change anytime soon?
There is belief that there is likelihood of that happening. Think about it. When Tom Keene is watching Sunday Night Football, Bills versus the Bengals, and he sees an ad on air that is talking about technical bank capital rules, that is not to convince him to pick it in front of the Fed, but that is to try and shift the Overton window. That is to try and anchor the negotiation so that even if you don't get a complete unwind of the rules, at least water it down enough that they don't feel threatened. As it is, the banks clearly are facing this dominant challenger, the growth of private markets. What they used to do is being done elsewhere. That's already hurting them. They just feel these new rules, which are over and above everything you've seen in the last 15 years, will only continue to hurt their future prospects.
Okay, so let's go there. Yesterday we heard from Mark Rowan that, you know, he doesn't think that Jamie Dimon wakes up and worries about the little fish in the pond, Apollo. Do you think that that's true?
Absolutely not. I mean, that's the one bit. It was a fascinating interview with Mark yesterday, but that is the one bit I disagree with him. The big bank executives absolutely wake up every morning thinking about the mighty Apollo, the mighty Blackstone, the mighty BlackRock, and everyone else. Because what is happening isn't just that they're finding a new niche and a new corner where they can go and sell their wares. What is happening is the business that banks used to do, regular way, middle of the fairway banking business, is being shifted into the non-banking space. Mark Rowan said it himself. He said the majority of their credit investments, and they oversee about $500 billion in credit assets. He said the majority of their investments are in private investment grade. That's just a nice fancy name for commercial lending. That's what banks used to do.
All right, but if you take their point, it's not borrowing short to lend long. They're not taking customer deposits and having to offset the risk or other types of short-term instruments and then using those for longer-term loans. That maybe that's a more appropriate place to have it. And still you see the JP Morgans of the world delivering record profits. So what is the business case that this is somehow wrong? That this is not actually a sort of correct transformation that's underway?
I think the conventional wisdom is to go out there and say, this is really scary, this is really worrying, this is something we should all be panicking about, and that the private market, especially the private credit space, has not truly been tested in a crisis. But there's something else that Mark Rowan said yesterday, which I thought was interesting. For the longest time, the worry was private markets meant more risk. He's saying now it just means less liquid. And when you have that match where you're looking out at a 10-year horizon, you don't have to return money at the start of every week or the start of every quarter, maybe it's not a problematic space to be in.
Retirement savings. If you're making a multi-decade trade, do you need daily liquidity? Which essentially is the argument they're trying to make, right?
Yes. At the same time, around the edges, just to push back a little bit, they're increasingly coming up with individual retail types of options that do have different kinds of redemptions. And then there's a question of just transparency, right? That's something that we've been talking about.
I get what they were saying yesterday. We're not in the maturity transformation business. We're not a bank. I understand all of that. Sri, isn't the risk that we're about to see all this activity shift to private markets, and this is not certainly about Apollo, it's about what happens everywhere and elsewhere, that you start to get bad lending elsewhere?
No, don't get me wrong. Just because we're trying to say that this is perhaps a good idea, this is not all that bad, doesn't mean something bad will not happen. Wall Street has a history of taking a good idea, pushing it to the absolute limit, tipping over into the greed space, and then you have problems. And so you have a market that's grown from, look, private credit markets have existed for decades, but really in the last 5 years, they've gone from relatively nothing to 1.6 trillion to, you had BlackRock just earlier on saying the private markets could grow to 3.5 trillion. That is rapid, rapid growth. To say that every actor in that space will be acting responsibly and cautiously beggars belief.
Do you think the smaller players are going to get left behind here when it comes to financing the economy? That it's going to be more and more difficult, that if you're not big, you won't find service?
Not necessarily. For every business that needs a $300 million loan, a $400 million loan, there are small businesses that need a $5 million loan, $10 million loan. Apollo and Blackstone and BlackRock can't be in the business of servicing them. So you will have small players in that space as well, which is why the banking executives also expressed this concern that you have heaped on so many regulations on us. You have focused on the banks over the last 15 years, and we are governed by that regulatory sandbox. You have nothing of any serious magnitude in place for this other space, which is growing phenomenally rapidly.
But this really isn't the purview of the JP Morgans of the world. It's more of a concern for some of these smaller or mid-sized banks that would be catering to some of these smaller or mid-sized businesses that really do account for a greater part of the consumer loans that already some of the bigger banks have gotten out of. So how much is this a story for mid-sized banks and not as much that big of a concern for the bigger banks that already have kind of established their lanes and been highly profitable at it?
I'd argue that up and down the banking stack, it affects them. Middle market lenders are probably looking at the mid-sized banks and the business that they do. But the big lenders are also looking at the business that banks do. The big banks do. Yes, banks have gotten out of a lot of it, not necessarily willingly, there is money to be made and they would have liked to make it. Just because they made $1 trillion in the last 10 years doesn't mean they did not want to make $1.5 trillion. They have lost out on potential excess profits. And what they're saying is, if you impose new rules, if you impose more restrictions on it, even that $1 trillion might not be repeatable in the next 10 years. That is their worry.
Sri, looking forward to the hearings a little bit later. I know you are as well. Sri Nellarajan there of Bloomberg. Some breaking news for you, Bramo. Drum roll. You ready for this? Time Person of the Year. Who do you think it is?
I'm going to sing a song, but I don't even know who it is. This is not at all Taylor Swift.
Let's get it on screen. Taylor Swift, Time Person of the Year, 2023.
She basically kind of guided the American economy. Some people say that the entire
5% plus GDP in Q3.
Exactly, is entirely Taylor Swift's kind of doing.
I'm not going to say what I think.
Come on.
I don't get it. I don't get it.
Why not?
I just don't get it. I just don't get it.
Players gonna play.
It's good. Like, it's catchy, but like, I mean, we're talking what? Comparing it to the Beatles and.
Okay.
No,
whoa. Okay. I'm not going to get into musical discretion.
I don't get it. I think she's brilliant, but I don't get it.
People love her. People deeply love her.
I understand.
Would you see the movie?
I understand.
Would you see the movie of her tour?
No.
Why?
Just not
Don't
interested.
you want to see the economic phenomenon that is Taylor Swift?
I can see it in the numbers.
You're going to look at a spreadsheet. I'm going to try to understand Taylor Swift and her number of costume changes through the spreadsheet.
I think it's great she's so loved and it's bringing the country together. I think that's great. It's good that we can get behind something together across party lines.
Oh, that's the most diplomatic.
That's it.
Yeah, wow. Wow.
That's
Look at that. I mean, anytime you put her on screen.
That's not even real dancing. Give me a break. Stop it.
Would you like to demonstrate what real dancing is?
Thomas Kennedy's going to do that of JP Morgan Private Bank. He's going to break down the bond market and show us his Taylor Swift dance. All of that still to come on Bloomberg TV and radio. Your equity market on the S&P 500. No, seriously, congratulations, Taylor.
Oh, yeah.
What a success.
She feels just warm and fuzzy inside.
She's waking up and watching this morning.
Yeah, exactly.
Congratulations. Okay. Futures up 0.2% on the S&P. Yields higher by a couple of basis points, 4.1820 on a 10-year from New York City. This is Bloomberg.
The shape of the On athletic shoe is unique. It can't be mistaken for any other brand. The structure of On's C-suite is just as distinctive, starting at the top with a pair of CEOs.
What we realized very early on is if you're adding different capabilities to each other and you do that as equals, then this leads to better outcomes.
Mark Maurer joined On as Chief Operating Officer in March 2013. Martin Hoffmann arrived as CFO that July. In 2021, they jointly assumed the CEO role.
We are a brand that needs to be excellent in designing product, in innovating product, but also in shipping millions of parcels from A to B in the most efficient way. So we need to have very different mindsets and very diverse people. Mark has different strengths, I have different strengths, and if you take us together, you just get more.
Companies with co-CEOs are rare, but On's configuration is even more unusual. Martin Hoffmann also holds the CFO position. He says his two jobs complement each other.
I actually feel the CFO makes you a better CEO, and the CEO makes you a better CFO. Understanding what you build as a CEO helps you to understand your numbers, and understanding the numbers helps you what are the right things to build.
Daybreak Europe, I'm Kriti Gupta. Let's get to the stories that set your agenda.
Taking you from the U.S. market's close.
A lot of this was priced into the U.S. session.
To the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in. We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
We've had the great rally, and now it's just kind of a chillax.
It does seem that the risk at this point seems more concentrated in equities.
At some point, I do think we probably want to turn bearish on this market.
The question into 2024 will be, can we stop the cooling before the economy tips into contraction and makes us all nervous?
I would argue that the Fed put is sort of back in the market right now.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
AMH sending in hate mail. I'm not a Swiftie, but I happily defend her injection into the economy. She writes her own music. I agree with all of that stuff. I agree with all of that stuff. That's great.
And she's also supportive of women.
Fantastic.
There's sort of a real sort of pro-woman.
I'm supportive of women too.
Okay.
Okay.
I was doing some research, and there's a lot of academia behind Taylor Swift and her popularity. We can get into that later.
I'm happy to get into it now. Just because I say I don't get it doesn't mean I actively dislike a person. You know, I think it's great. The success is phenomenal. It's amazing to see how much money's been spent on that tour.
If someone gave you a ticket, though, would you go?
It depends how much that ticket was worth.
Really?
Yeah.
Okay, so in other
resale
words,
value.
Yeah, but the historical context of understanding.
No, absolutely not.
I think
resale
that is fascinating.
value. Okay.
Just nuts and bolts.
And then
finance.
then I give it to an asset manager who is looking to go into private markets. All right.
We're talking about this because
we'll see how that money compounds over time.
Time person of the year. Okay, great.
In a couple of decades, and you tell me how that Taylor Swift concert was, and I'll tell you what's in that fund.
Great. I think I will have a happier experience.
Okay, good to know. Taylor Swift, congratulations, Time Person of the Year. From New York City this morning, that is not what you tuned in for, I know. Good morning, good morning. This is Bloomberg Surveillance on TV and radio. Alongside Lisa Abramowitz, I'm Jonathan Farrow. Your equity market's positive here by 0.2% on the S&P 500. In around 15 minutes, you'll get the ADP report. It is the appetizer for the main course. That's payrolls Friday. And Lisa, typically, we know how this goes. It doesn't matter until it does.
And right now, the narrative that I am hearing is the one that people might lean into is this question around rate cuts. That yes, they are coming on softness that we saw yesterday in the JOLTS report, but if we get a weaker number, that we could see the bond rally continue, but the stock market falter. And that, to me, is the increasing kind of rumblings under the surface right now.
The data's not saying that right now, though, right? Just had a third quarter of 5% plus GDP growth. Let's take yesterday. Talked about this a few times this morning. Forgive me if you heard it already, but it's fresh for other people. The perfect mix of growth and inflation at the moment. Growth is still robust. The ISM was still decent. Prices paid beneath the surface came down. Job openings have dropped to the lowest since spring 2021. You couldn't make it up any better. That just looks great. So the question I'm asking, can the growth inflation mix get any better than this? Isn't it just kind of downhill from here into next year?
That's what I like. That was a good take on
There we
it.
go.
I appreciate it because
Less
of the
Taylor,
skepticism.
more Bramo.
Oh, well, first of all, Taylor probably was responsible for the 5%. And I will just say that somebody did write in saying the 0.01% chance that you had in getting the 13-year-old daughter interested in finance went out the window.
I got the same
with our discussion
Yeah, I
for
know.
Taylor Swift. So there is that. But I will just say, there is this concern that everyone's bought into this perfect soft landing nirvana. I keep using that phrase from Neil Dutta. And that basically, as Goldman Sachs' Scott Rubner said in a report, there are no longer any bears left, and that doesn't make people feel very good.
No, sentiment has shifted pretty quickly.
It has.
In November, what a difference a month makes for equities and for bonds as well.
I'm exhausted. This year has been just whipsawed of different narratives that all have validity, and you can pick your narrative, but really, I think that Liz Ann Saunders put it really well. The rolling economies.
Rolling
recessions, and then we heard rolling recoveries from Pinky Chada, right? I mean, these are sort of the different stories that are moving on different cylinders that lead to a very complicated reading in a very complicated moment.
Example, this is a good one, ECB. You said this, and I think you're absolutely right. A couple of weeks ago, someone comes on this show and they say, the ECB is going to cut by 150 basis points. They'll start in March. You sit here and you go, okay, what did you smoke this morning, right? 3 weeks later, Deutsche Bank comes out, says, this is what we're going to get from the ECB next year. 150 basis points of cuts, and they might start in March. And everyone turns around and says, you're just following markets.
Exactly. What took so long?
Just what's priced.
Pretty much.
Thanks for playing. Thanks for catching up.
Your consensus. That's basically how quickly things have shifted. Now we're looking at, about 100 basis points priced in of Fed rate cuts, all with equities still continuing to do well and people expecting the employment picture to remain benign.
Everyone's exhausted, including the bank CEOs. You'll hear from them at about 9:30 Eastern Time on Capitol Hill in front of the Senate Banking Committee. There are going to be two big issues at play here. One, transferring risk to private markets. We joked about that briefly. And two, compromising their ability to finance the economy. They're going to push on that really, really hard. There's this quote here from Jamie Dimon at JP Morgan in prepared testimony. Banks would be limited in their ability to deploy capital in the times we're most needed. And the rule will have a harmful ripple effect on the economy, markets, businesses of all sizes and American households. The rule we're talking about, essentially, is higher capital requirements. They're going to push back big time later. Is anyone going to listen to them? And that's the question.
Especially given the fact that they just delivered record profits. They're still delivering those. And so how much can they say, well, we're not going to be able to continue to, and we need to remain stable? Nonetheless, will the economy, will markets listen to their economic calls, given that people are looking for some sort of indication of what's to come next?
How do those economic calls work out sometimes?
Well, theirs not so well, but Walmart's CEO may be a little better.
All right, we're joining one of theirs in a minute.
All right, let's find out.
Thomas Kennedy's going to be standing by. He can't wait. Don't worry, Tom. What I'll do, if I put a market check in between, everyone forget what Lisa said 60 seconds ago. So here's the price action. The scores look like this on the S&P 500. Positive by 0.2%. Yields up by a couple of basis points. 418.58. Coming up a little bit later on this morning, the ADP report. 130 is the estimate. The previous read is 113,000. Mike McKee is going to break that down for you in about 9 minutes' time. Going into Friday, 187K is the estimate for payrolls. The previous read was 150. We had Ian Shepperson of Pantheon Macroeconomics on the program a little bit earlier this morning, who was looking for something closer to 300K, Lisa.
275.
Amazing.
And given the fact that he said that, their early indicators keep showing this, that said, 50,000 here is government, 40,000 here is some of the union. You start putting this together, it's fine.
Let's get to Tom Kennedy.
Let's do that.
See, everyone's forgotten that, Tom. It doesn't matter. Good morning to you.
I'll bring it up.
Let's talk about payrolls on Friday. What are you looking for?
We're looking for the continued moderation in job growth, consistent with an economy that is rebalancing, to your point, without much economic pain. The moderation in the labor market is a necessary requirement for the durability of this soft landing. But when you look at the balancing act between inflation and growth, or inflation and labor markets, the inflation side of things is already there. And I think that's what economists in Wall Street are coming around to. And November was, to your point, a historic easing in conditions because of this reality. But in prices, last 6 months annualized core PC, 2.5%. If you adjust for housing, which we know is lagged, you're around 2% on inflation. So John, is this as good as it gets for inflation? For the moment, this is perfect. But is it durable for the soft landing? That's the question we're all going to rotate to. Payrolls will be important for that.
So do you believe in Goldilocks? What kind of payrolls number would confirm Goldilocks?
150,000, give or take. Why does that confirm it is you're still seeing the deceleration, but not falling off a cliff. And that durability of, can we get the soft landing in the economy, prices stay around 2%, but growth slowly comes down towards trend. If you're at around 150,000, at least give or take, I think you're showing that consistent decline in payroll growth, and then you can start talking about job openings, then you can start talking about the quit rate, which should be consistent with wages declining.
Does it make you nervous that so many people are buying into Goldilocks? That the idea that Goldman Sachs put out there, that there are no longer any bears left because everybody is buying soft landing nirvana?
Our process is to look at what's in the price. Beyond just like what the sentiment and the behavioral experience is. If we've learned anything in COVID, things move fast and we are behavioral organisms. You look at what's in the price for equity markets, and yes, at the index level, you're talking about PE multiples that are near historical averages, Magnificent Seven types of stocks trading expensive. That's the place where you're getting earnings growth. start to adjust and do maybe a PEG ratio, comparing PEs to growth. That's the only place we're going to get growth if rates are this high. So I think we should pay more for those. Everything else, relatively inexpensive. Have we been exuberant in a 1 month period? Maybe, but I do think there's still value in some of those names. The conversation I think we're all going to be having for the next 3 months is, okay, if I can buy equities, what do I buy? Is it large cap? Is it mid cap? Is it small cap? Because if you're going to get this soft landing, those mid cap and small cap stocks, they're going to rally a lot.
What's the call right now for you, the base case?
Our baseline scenario is moving towards this softish landing and respecting that the process of getting a rebalance in the economy is never perfect. But you can, at this moment for investors, you have so many choices to get your money where you want it to go. You have a cash rate at 5.5%, won't be there forever. That's what the market is fully recognizing, timing that's hard. But you can get fixed income yields that will help you meet a goal for the first time in over a decade. They're going to help you get there. And then in stocks, what we've seen in our community, people have raised cash in the last 2 years, increased by 10 percentage points at the expense of risky assets. November's showing you if we get a soft landing, those things will perform really well.
Before we get deeper into fixed income, I'm pleased you brought up earnings. Are you confident the earnings recession is now behind us and not in front of us?
The earnings rolling recession is one that really works for us. These are somewhat like micro recessions post-COVID. Tech was the one that was the biggest struggle in 2022 and into early 2023. They're inflecting out of it. And just about all calls, guys, are going to rely on the tech sector. Has to work. It's just a huge piece of the S&P 500. But those earnings are inflecting higher. What we're seeing from these big tech names is they're doing CapEx. I think they've shown us they're pretty good stewards of capital, and that CapEx will be a good return on investment. Expected earnings for next year around 240 is only saying Q3 2023 will just happen 4 times next year. It's not really embedding a substantial increase in earnings growth, just suggesting what we've done can keep happening.
It seems like there's a shift in what you're talking about, because 6 months ago you seemed much more interested in credit than you did in equities. And the fact that you're talking much more about equities raises this question in my mind. What's changed for you? Why is there suddenly such a better value proposition in stocks?
Because the Fed put is coming back in the money and is coming back really quickly. You're right, John, to say in the earlier segment, there are good cuts and there are bad cuts. But nonetheless, we're talking about cuts. And the trade-off between growth and inflation a year ago was massive. And as recently as June, the Fed was projecting that we're going to have a recession. But inflation has come down, and we haven't had much economic pain. They're getting closer to the ability to say, our inflation mandate is reached, so now we can start to support growth. And all else equal, they have lots of room to cut. If things get worse, they can support the growth outlook. And that cut just keeps coming closer and closer. That's, I think, the thing that changed the most.
Why wouldn't that help credit most of all?
It will support credit. Credit spreads are rather tight. There's likely, as Amanda said in your prior segment, there's likely to still be some distress, right? There are names that just can't live in an environment where interest rates are 200 basis points above where they were two years ago and 100 basis points above where they were 5 years ago. But that doesn't mean the entire complex is going to feel material stress. And credit can perform quite well there, but the equity market had been discounting this world where rates would stay high forever. And I'm being dramatic there, of course, but we're slowly seeing that that's not the reality one way or another.
BlackRock, new regime. Wei Li in the last 24 hours saying, new regime, higher volatility, rates are higher for longer. When we start cutting, I get the direction story. It's hard to push back against that after the data that we've seen. Let's talk about what we're going back to. What are we going back to? 3, 2s? What do you think it is?
Our 2024 outlook, we called it the rate reset, investing reconfigured. We have to, for our community, where we've seen cash allocations get raised at the expense of risky assets, and guys, only 4 out of 5 of our clients have adjusted their fixed income portfolios. No changes, no material increases. We can get portfolios where they want to go with less risk than we did pre-COVID, simply because rates are not going to go back to that 0 rate environment. So John, to answer your question, what do we pencil in? I think a 10-year rate will settle around 3.5%. And that's lower than where we are today.
So like the new normal is the old normal, kind of think.
Really old.
One of my best advisors grabbed me and said, I hear you talk all the time. All you're saying is go back to my portfolio I had in 2006. That's a simplified way to think about this rate reset. I think we are. I mean, we get the great luxury at JP Morgan, all these people giving us feedback. I thought that was the best summary conclusion of what we talk about all day. this has been a reset to what we all have seen before, but it's a higher interest rate regime where the world will exist just fine, but we should reconfigure the way we invest.
Just to be clear, that's not a call on what happens 2 years later, right? It's just what the portfolio looked like in 06.
From an asset allocation perspective, we know what the right thing to do was, and it was to actually take up fixed income allocations. And that's what we need to do.
He just wants you to say we're not heading toward mortgage Armageddon, and this isn't necessarily a call.
No,
on
not
that.
implying that, just in case people are wondering, well, what happened next?
Right, exactly.
You know,
It's not
I know
exactly
what
saying.
happened next.
Right.
Good things didn't happen.
Yeah, you guys spend a lot of time on where leverage has accumulated. It's not at the consumer. It's hardly in the banking sector. So, like, are there stresses and will there be credit issues? Of course. But will they be perverse and form a crisis? We see very low.
It's
low
at the
risk of
Treasury.
that.
We talked about this yesterday.
I was going to say, it's all
Where's
governmental.
the leverage built in this cycle? It's the Treasury. Tom, it's good to see you. This was fun. Tom Kennedy of JP Morgan Private Bank. Thank you, sir. Got some economic data drop in just a moment. About 15 seconds away, you'll get the ADP report. Mike McKee is terribly excited. He's joined us around the table. The estimate right now for the ADP report is 130,000. Going into it, equity futures shaping up as follows. Futures positive by 0.2% on the S&P 500. Yields look like this on a 10-year, higher by a single basis point. The data drops, and Mike McKee hits a downside surprise.
Yeah, so does the ADP number drop. 103,000, that is significantly below the 130,000 you just mentioned as the expectation, and the 113,000 unrevised from last month. I'll see if I can pull up the revised number. Most of the decline, it seems to be, is in goods producing, which is kind of interesting. Manufacturing, they say, loses 15,000 jobs. Now, most analysts are penciling in a big increase in manufacturing jobs because the UAW workers go back to work. So that's kind of an interesting view from ADP. Service providing jobs, 117,000, and it looks like most of the job creation that there was in medium-sized establishments. Now, the other aspect of ADP that they have produced in recent years is the median change in annual pay. Job stayers, 5.6%. That's a slowdown. And job changers, 8.3%. That is a slowdown. Now, what does all this mean? I don't know. People trade on ADP because they trade on ADP. The last time we had a number this small was 89,000 in September for ADP, and non-farm private payrolls came in at 246,000. So you pays your money, you take your chances or your choices or whatever. I will say the whisper number still remains very low for Friday compared to...
What is it, Mike?
It's a 156 was the last time I looked this morning, and we're at 187 for overall payrolls.
Previous read 150. Mike McKee, prepare for the question that I ask you every Wednesday before payrolls in just a moment. Here's the price action on the S&P 500, shifting higher by 0.2%, unmoved in the equity market, up 0.3% on the Nasdaq. In the bond market, yields were a little bit higher. They turned lower. Now they're still higher by a single basis point. 2-year, 458.67. Off session highs on a 10-year, 417.43. Mike McKee, are you ready?
Yeah.
Does this mean anything for Friday?
No.
Okay, thank you.
I mean, you can add it into the whole long list of things you put into your model, but I think most people have already accounted for what they think ADP might do.
Ramo, isn't it always the way?
It is.
Shifts markets for 5 minutes, and then economists sit around a table and say, no, doesn't matter for Friday.
It doesn't matter at all.
Me employed.
Well,
I mean, I get to come out here and talk about it.
Hold on a second. They say it doesn't matter, but then when the jobs report comes out, they'll throw ADP in as the tea leaf that showed some sort of softening.
Yes,
if
of
that
course.
confirms in the narrative. So it's selective
Whisper
data
number
feature.
150. 150 something.
Well,
156.
I'll double check right now, but it was 157 this morning. So
187.
Yeah,
payrolls on Friday.
It's 158. It's moved up. Maybe that's an ADP response.
Mike McKee, thank you. The median estimate in the official survey here at Bloomberg, 187K. With us around the table, I'm really pleased to say, the brilliant Libby Cantrell, the Managing Director and Head of Public Policy over at PIMCO. Libby, good morning.
Good morning.
Another big debate for Republicans
Another
a little
big
bit
debate.
later.
Yes.
Is this the big one? Does it make a difference?
This is the big one. So this may be the last one, actually. There's not another debate scheduled before Iowa, when voters, of course, on the Republican side will go to the polls on January 15th. Viewership has declined since the first debate. That's when we saw sort of a top tick of 13 million. The last debate was around 7 million. So we'll see if people are even paying attention to this. I think the real question, though, John, is can Nikki Haley have another breakout moment? Does this sort of sustain the momentum that she has, both in terms of the polling, but very importantly in terms of the donors? And that remains an open question. I think that the other three folks on the debate stage will be sort of attacking Nikki Haley. I think Nikki Haley will be attacking President Trump. So it should be raucous as usual, but does it actually make a difference? I think that's the open question.
What's the chance that you see another Biden-Trump matchup?
Well, so, what we're guiding our clients to is, one, is that Biden will be the nominee. This sort of idea that there is some great cabal at the convention that will unseat him, we just do not think is founded. Senator Brose from Louisiana, who had served with Joe Biden in the Senate, said, as long as President Biden is breathing, he is running. And I think that is something we should just take for what it is. On the Republican side, obviously, if the primaries were held tomorrow, it looks like Trump would be the nominee. They're not going to be held tomorrow. They're held in around 40 days. And what we've seen with Iowa and New Hampshire is that things can change. They haven't really changed in terms of dictating who the nominee is since 2008, when Obama, who was sort of underperforming all of the polls, then really outperformed in both Iowa and New Hampshire, and was able to get the momentum to the nomination. So a lot can still happen, but as of now, if you were saying if the primaries were held tomorrow, it would be another Biden-Trump rematch. And, ironically, I'll just say, is that 70% of Americans don't want that. So
that's the reason why I think it got so much attention yesterday when Joe Biden said if it wasn't for Donald Trump, he wouldn't be running again. What do you make of that? Do you make that if Nikki Haley is the nominee for the Republican side, that there is a chance that Joe Biden would step down and pave the way for somebody else?
So his press shop really walked that back last night after those comments were made. They were made, of course, in private at a fundraiser. So it was maybe, I think they're saying, taken out of context. However, I think this is something that President Biden has been saying since he was a candidate in 2020, that's why he was running the first time. And so this is somewhat consistent with that messaging. However, if Trump does not get the nomination, I still think that President Biden is the incumbent president. He believes that he really has a record both on the economy and then foreign policy to feel confident to run on. So we are not getting sort of any indication from folks close to the Biden world that he's not running. He is running.
We would all appreciate, I think we could all benefit from a delegation allocation rules clinic from you. How have things changed for Republican primaries?
Especially as a U.S. citizen. So I appreciate, John, that question. So this is important. It's very nuanced, and a lot of our clients' eyes understandably glaze over. But to get the nomination, it's just a delegate game. You need to get 50% of the delegates at stake on the Republican side and the Democratic side. The Republican side is the real story here, though, because the Trump campaign, much more organized than it was in 2016 by their own admission. They have now sort of systematically changed the way that states allocate delegate rules to benefit him as long as it's a crowded field, meaning that they've changed the rules to what's called winner take all. So as long as President Trump is winning a plurality of the vote in many states, he will get 100% of the delegates. And the punchline kind of for all of us is that makes it much easier for him to get the nomination much more quickly. So I would argue that by March 5th, which is Super Tuesday, we'll have had 45% of the delegates at stake being voted on. We likely will have a very good idea of who's going to be the nominee, or whether it's going to be more of a competitive two-person race, as you said.
So we know there's 4 people on the stage later. Is there a date on the calendar where that 4 needs to become 1 to change the outcome of this?
Well, I think there are a lot of folks on both the Republican side and then also some on the Democratic side. As you've seen, there's some now Democratic donors who are, donating to Nikki Haley. Sort of interesting, unprecedented in many ways, who are trying to argue for a Chris Christie to, say, drop out of the race before Iowa. John, I think what we've seen, though, before is that, again, so much can change, that much of this is unprecedented, particularly given what we might be facing, which is two incumbent presidents effectively running against each other. So I don't think there's a drop dead date, but I do think that it needs to become a two-person race, sort of by South Carolina. That's February 24th. So I think the bottom line for kind of the markets and for investors is that the next 75 days really matters. We will have a very good idea by sort of South Carolina, by Super Tuesday, which is March 5th, whether this is going to be President Trump, Biden, or whether it's going to be more of a two-person race between Nikki Haley and and Trump.
In those 75 days, we're going to be dealing with a couple of deadlines for funding the government. Before I let you go, we keep talking about where is the leverage. The leverage is in the U.S. government. I need to figure something out in order to keep operating. How are you advising people in the market to understand what's happening, what the likelihood of a shutdown is, what that means in terms of the growing risk, frankly, that it's been attributed to in markets?
Yeah, so I mean, I think there are two things. One is that this is not the debt ceiling, right? The debt ceiling was existential for the markets. That has been fortunately addressed until January or February of 2025. This is really the most foundational function of Congress, is just to keep the lights on. They keep kicking the can down the road, Lisa. Does it really matter if they shut down the government? Probably not if it's not for a sustained period of time. But if it does go on for weeks, then we don't get some of the economic data, then it could actually start hurting the economy. But I think this is just sort of noise. But I think the punchline here from a fiscal perspective is this effectively funds the government at the same levels as last year. And what we're not going to see any more fiscal stimulus. And I think the threshold for any sort of stimulus, even if we do go into recession, I know your previous guest was pretty sanguine about the economy. I think we as bond investors are a little less so. But the threshold for any sort of fiscal stimulus is going to be very high. So we think the government probably will be funded, probably at the last moment. But again, from a market's perspective, we're not sure. There's more noise than really anything.
It's always the way, isn't it? Equities, hopes and dreams, bonds, fears and nightmares.
Yeah. Do you know who I relate to?
Yeah, obviously. Obviously.
Well, yeah.
Libby, thank you.
Thank
it's good
you
to
so
see
much,
you. Great to catch up. Libby Cantrell there at PIMCO. Obviously. I mean, no one thought you were an equity kind of person, did they?
No, I
Hopes and
would
dreams,
make it terrible.
Sunshine, rainbows,
I have
and
to
unicorns?
say,
Absolutely not.
One of the progeny actually said to me, I don't get equities. I just don't understand it. It seems like all stories. And I said, yeah, welcome.
Just stories.
Well, no, I mean, it just doesn't have the same kind of nuts and bolts.
It's the hopes and dreams and optimism of human nature, Bramo. That's what it's about.
I love it. I wish, but that's just not my nature.
A beautiful thing. Coming up on the Open, we'll talk about hopes, dreams, and fairy tales. Goldilocks even. AJ Oden at JP Morgan. Dan Skelly at Morgan Stanley, Subhadra Japa of SocGen, just to get some fears and nightmares in there. We'll talk bonds, Bramo. All right.
Thank you. I appreciate that.
From New York City this morning, equities positive by 0.2%. A beautiful New York. This is Bloomberg.
tag on the product may read Made in the USA, but the sign on the CEO's door often says Made in India. Alphabet's Sundar Pichai, Microsoft's Satya Nadella, IBM's Arvind Krishna, Micron Technology's Sanjay Mehrotra, and that's just the start. Add in the chief executives of Adobe, Deloitte, Gap, VMware, and that doesn't count Indians running companies all over the world. Why have so many Indians risen to the top? Vinod Khosla points to India's incredibly competitive education system. If you can survive the pressure it takes to get into one of the Indian institutes of technology, it gives you confidence to handle American universities and later the business world. Meanwhile, the belief in India's ability to produce so many tech wizards is reinforced every year. Indians make up about 3/4 of the immigrants receiving coveted H-1B visas for the U.S., and it's a safe bet that some of them will eventually find their way to the C-suite.
The top names in global leadership are on Bloomberg.
What we've just delivered are significant tax cuts. For business, we will be the only major G7 economy, certainly, and even broader than that, where you get a total write-off against your taxes for capital investment. And it comes on top of the fact that our corporation tax rate here is lower than any other G7 economy. That's an incredibly generous regime to attract business investment.
Nobody covers the top global leaders like Bloomberg Television and Radio. Context changes everything.
60 minutes until the start of opening day, trade day in New York City. We are looking at a little bit of a fade in some of the sell-off in treasuries, almost flat now in terms of the yield space after ADP numbers came in lighter than expected, raising questions about whether we can expect a weaker number than current Wall Street forecasts on Friday for non-farm payrolls. That is giving a little bit of a bid to the S&P, which did see a bit of a downdraft yesterday, up about 0.25%, 45.87. The euro, fascinating to me, not because today is particularly dramatic, but just that steady loosening from what we saw last month. The fact that the euro is weaker versus the dollar, 107.91. We've been talking about it all morning, the idea that suddenly people are looking for the ECB to cut rates, to ease policy starting next March as inflation underwhelms. We're also focused on the circus, the media circus that's going on in Washington, D.C. This time, Wall Street heading down there, bank CEOs testifying on Capitol Hill. It starts in about an hour time. Witnesses include Jamie Dimon of J.P. Morgan, David Solomon of Goldman Sachs, Brian Moynihan of Bank of America, and many others. In prepared testimony, Dimon warning of tighter capital requirements leading to higher costs for customers, writing, quote, "This rule will make services so uneconomical, you will likely see two outcomes. Many banks will simply stop offering certain products and services, and those that do will have to charge more for them just to make it worth the service." Down in D.C. is Sonali Basak, our own Wall Street correspondent. Sonali, what are you looking for? What do you think is most notable from the testimony that at least has been released before these hearings?
Yeah, Lisa, I'm standing in front of the building where the bank CEOs will be walking into and testifying in about an hour. And to your point, they have their own agenda, which is fighting against those capital rules that are put forward by the Fed. How much will that actually change? Unclear, right? These rules have been in the works for a while and will take a while to implement. But listen, as you noted, Jamie Dimon had said to senators in the prepared remarks here that this is not a threat. It is just an economic reality. And if you look also at David Solomon's testimony, for example, they don't even just make it about the banks. They make it about the broader American economy. And he says this could really start to tighten lending standards and costs for things like food manufacturers, airlines, and all sorts of things that impact the real American economy. The lawmakers will have their own agenda. There's been a lot of frustration, you and I have seen this for years, about the fastest set of rate hikes in decades by the Federal Reserve, and so very little of that passed on to the American consumer in the form of savings rates. And most of the banks on stand really today will be hearing questions about why that's been the case, especially given that they have minted record profits in recent years.
So in other words, everyone should get more fees for their deposits and their savings accounts. I'm just curious for a little bit of history, Sonali. Why does this happen? What is the purpose of these hearings that happen on a regular basis?
Well, a few things. Remember, we did not see this annually after 2008. We really only started seeing this in 2019. In 2019, Maxine Waters really called the banks down to Washington. A lot was going on in the American economy at that time and socioeconomically. This happened in the wake of the George Floyd murder, for example, and there was a lot of frustration about these banks not serving low-income and minority communities. That was a big feature of a lot of these hearings. This week, we're not going to see hearings in the House. We will see them them in the Senate. And Sherrod Brown, Ohio senator, has also voiced similar concerns about these big banks leaving citizens of America behind. And the point that they're trying to make to you is that they still serve 2/3 of the American economy in terms of capital lending. And Jamie Dimon putting out the big PC word out there, private credit is going to take over your lunch if you squeeze us even more, and they might not be as kind to your people as we are, is kind of the undertone here of the testimonies.
I'm just wondering, Shanali, from the other side, when you're talking about Wall Street executives saying that this could cut credit to the broader economy and hurt the broader economy, what did we hear yesterday from Goldman Sachs at the Goldman Sachs Financial Services Conference when a lot of these CEOs were speaking in terms of the state of play, where they see the consumer, where they see the economy heading?
Yeah, you think about Brian Moynihan, for example, who's now starting to talk more about a slowdown, and I lean on Brian Moynihan for this discussion for a little bit because he's kind of the most optimistic of the group. You have seen him talk a lot about how things are going to be okay. But when you have heard David Solomon and Goldman Sachs for a long period of time, their tone has even been more constructive over the last couple of months, even though everyone thinks that there's a slowdown coming. Now, what's interesting about all this, too, is for the banks themselves, while many of these banks that are presenting today are laying off staff by the thousands, sometimes the tens of thousands, some of the headcounts have become more bloated, like JP Morgan, for example, and each of them are facing pressures on pay. Think about how many banks that are testifying have raised their minimum wage, for example, in the last couple of years. Really, by the way, Lisa, on the back of these hearings, I think a lot of people think of this as ceremony, but overdraft fees have been attacked and changed in the wake of these hearings starting. Pay has been addressed in a very visceral way at many of these banks in the wake of these hearings. And so these annual testimonies actually do make a difference in the case of a banking sector, though there is a lot of politicization, of course, and a lot of frustration and concern about the direction of the economy, certainly from the top bankers as well as the lawmakers who are questioning them.
Shanali Basak, thank you so much for being with us. We'll look to your coverage all through the day, and hopefully the wind won't blow you away. Thank you so much for being with us. As we were speaking, we're seeing a little bit of a more pronounced move in the bond market in particular as people parse through some of the economic data that we just got. ADP came in at about 103,000 jobs created. This was below the 130,000 expected. Also, the prior month was revised lower, 106,000 from the previously stated 113,000. You can see yields now lower on the day. 10-year yields 4.16%, heading toward that lowest level that we've seen since the end of August. You can see it give a little bit more of a pop to the S&P, but there is a question here about whether this is still kind of a Goldilocks nod to what we might see on Friday. Joining us right now is Michael Puglisi, senior economist at Wells Fargo, and I want to start there. Are the numbers that we just got from ADP, A, important, and B, pointing to the same soft landing that's been driving the narrative through the month of November?
Yeah, well, thanks for having me, Lisa. And the way I kind of think about that is the ADP numbers are, they're one piece of the puzzle, but they're a relatively small piece. And so, I don't put a lot of weight on what that's going to tell us about the much more important non-farm payroll numbers. ADP tracks the non-farm payroll numbers fairly well on like a longer-term trend basis, but month to month, the relationship is pretty weak. And so we're actually a little bit above consensus on Friday. We're looking for 215,000 jobs. I think there is still some underlying strength in the labor market in addition to some seasonal quirks that might boost hiring a little bit in addition to the strike effects.
Is this a sort of perfect kind of strength, though? And we've been asking this for quite a while, given the fact that we've seen productivity increase, we've seen wage increases moderate, even at the same time that we see a robust hiring market. Is this still a perfect recipe with all the signals that you're monitoring?
I think that the slowdown so far on the labor market and growth and everything else has been encouraging, right? 600,000 jobs, 500,000 jobs a month, the pace we were seeing earlier in the recovery, that was never going to be sustainable, right? That was one of the many kind of data points that was fanning the concerns for the Fed of the economy running too hot. And so the path to a soft landing, to me, it always looked like slower economic growth, slower job growth that goes from 500 to 400 to 300,000, kind of on a trend trend basis. The hard part is sticking the landing, right? Is getting to 100 to 200,000 jobs a month, which is probably a kind of healthier, sustainable rate, and sticking that on a trend basis and not actually going into negative territory.
So let's talk about that. I mean, how much are you seeing that as still the likely scenario, given the fact that that's currently what the market is pricing?
Yeah, I think that it's a tough call. I mean, the market's probably gotten a little bit optimistic on this front, but I certainly feel more optimistic than I did a year ago when, you had much tighter financial conditions, inflation that just seemed to go up and up, a Fed that was hiking 75 basis points at every meeting, and slowly but surely we're getting there. I mean, inflation's still high. The Fed's preferred measure of inflation is 3.5%, depending on if you're looking, at headline or core. But generally speaking, I think that's an encouraging development for the Fed. And if they can continue that, right? You heard this from Governor Waller. If they can get 3, 4, 5 more months that look like the past few kind of quarters have, I think that allows them to slowly start cutting policy, regardless what's happening in the real economy, because they're finally seeing the inflation sort of getting in that ballpark of 2%. So we're not there yet, but I'm more optimistic than I was 12 or maybe even 9, 6 months ago.
We were just speaking with Tom Kennedy of JP Morgan Asset Management, and he was talking about how we may be going back to a 3 to 3.5% Fed funds rate world, where they'll cut to that level, and it's back to 2006 types of conditions, not necessarily with the mortgage market, but just in terms of portfolio arrangement. Do you think that that is an accurate reflection of just where we are in terms of rates sort of remaining higher than they used to be, but everything chugging along in tandem?
I think that's exactly right. So if you go back to kind of the late 2010s, what was normal for rates? Yeah, it was something like 2.5%. I think that was sort of a good neutral level. Above that would be tight, below that would be accommodative. And I think there are good reasons on a go-forward basis to think rates are going to be higher today than they were back then. Maybe an economy that's growing a little faster, inflation that's running a bit hotter, just generally speaking, more uncertainty in the world, a little more term premium. So I think that's right. At the end of next year, our 10-year yield forecast is 3.5%. With Fed funds a little bit above that still, with the Fed still not done cutting rates, but getting there to something in the low 3s. So that's sort of how I frame it as well. I think rates over the next decade are going to be higher than they were over the previous, but do I think 5% Fed funds or 5% 10-year yields are going to be what we can sustain over the longer run? No, I would take the under on that.
Okay, so bear with me on this, but do you think that in 10 years, when we look back on history and we take a look at zero rate policies, are we going to say that in some ways they constrained growth and that actually some yield on basic income-producing instruments is stimulative on the margins, all things being equal in terms of delivering income, particularly to people who are retiring or have big pools of assets?
I don't think so. There were certainly some challenges with ZIRP, with zero interest rate policy in the 2010s. It's not to say there were no negative side effects. I think there certainly were, but the 2010s was just a very difficult recovery. I think when I look back on history, 10 years back now, I think the thing that really strikes me is just how bad that recession was. Unemployment of 10%, very steep decline in real GDP, and a years-long recovery in private sector balance sheets, given all the debt challenges that came out of the housing bubble. And I think that the challenge there was you had all of that happening and some fiscal austerity that was happening in the early 2010s with the Eurozone debt crisis and the fiscal cliff and sequestration and, again, all the things we have now with those 10 years of hindsight. So zero interest rates weren't perfect. I think they had some negative side effects, but I do think that they were attempting to help an economy that had a lot of issues at that point in time with just the fundamentals.
If you are just joining the program, we did get that ADP report. It is fueling a little bit more boost to the risk on market that we can feel. S&P futures up nearly 0.4%. You could see sort of fluctuations in the bond space as people try to understand whether this is still a soft landing and still can price in some sort of increase in rate cuts next year. The S&P right now 45.91. Michael Puglisi of Wells Fargo is still with us. And Michael, I want to just get your sense on the 5% GDP growth that we saw in the third quarter. If we do go down to about 1.2% GDP growth in the fourth quarter, based on GDP now from the Atlanta Fed, is that the new glide path? Is that sort of the reality that you think reflects what 2024 is going to look like on a growth picture?
Yeah, you know, when I think about that Q3 growth number north of 5%, I don't even meet any optimists who think that's the real run rate for the economy right now. 5%, I think, was a quirk in Q3, and you see this, right? You see this in all economic data. It's why, you know, a monthly jobs number here or a quarterly GDP number there, you know, it only contains so much information, and what you're really looking at is the trend, right? Take inflation this year, where month to month inflation's bounced around some, but if you take a step back, it's clearly on a glide path down. And from growth, I think about it similarly. Coming off such a strong growth rate in Q3, we're probably due for a little bit of a letdown in Q4. And I would kind of average those off and say, you know, if you do get 1% in Q4, maybe we're sitting somewhere in the middle there. You know, 2 point something is really the true run rate. And I do think that'll probably decelerate further. I don't think we're going to grow 2.5% next year, let alone 5%. I think something, you know, a little bit weaker than that makes a lot of sense, given that there's still that lagged impact of tighter rates that you're seeing on job growth in many other parts of the economy.
Michael Blagisi of Wells Fargo, thank you so much for being with us. Coming up, the heated debate continues around academia, the role of free speech, what that means, as well as anti-Semitism and Islamophobia. Coming up, David Rubenstein of the Carlyle Group and host of Peer-to-Peer Conversations on his discussion with Bill Ackman. This is Bloomberg.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact the business and steer the direction.
We are like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. A new episode every month, only on Bloomberg.
Large following on X, or what used to be called Twitter.
Sure.
Is that a plus for your business or a minus for your business?
At worst, it's neutral, but probably no one's going to want to have a proxy contest with someone with 900,000 Twitter followers. Pretty thoughtful letter that was, I think 25 million people saw it on Twitter, and remarkably, I did not get a response, which to me is a very, very bad and weak approach. Literally no response, no acknowledgement, no, dear Bill, I hear what you're saying, but nothing. So yes, I'm an activist, but my activism today is probably not in the corporate boardroom. It's on campus.
That was Pershing Square CEO Bill Ackman saying that Harvard ignored his open letter to address anti-Semitism on campus. That was in an interview with the one and only David Rubenstein. You can watch more of that interview, which is fascinating and goes to one of the most controversial and important issues of the day, peer-to-peer conversations at 9 p.m. on Bloomberg Television. I'm so pleased to say joining me right now is David Rubenstein. I want to pick up on that point that Bill was saying, which is his activism is now not in a corporate boardroom, but on college campuses. And we heard this yesterday from Mark Rowan of Apollo. How much are you hearing that increasingly from some of your peers?
Well, there's no doubt that Bill Ackman doesn't need to be an activist in investing anymore because, as he said in the interview, he wasn't that well known when he was an activist, and therefore he had to get attention, and doing activist kind of things got people's attention. Now he's pretty well known, so he can avoid that part of his investing process. In terms of college and Harvard, he has been very active at with his letter to Claudine Gay, and Mark Rowan has been very active at Penn as well. And a number of other business people have been active. There's no doubt that there's a lot of concern in business, but other communities about what's going on college campuses. And as we all know, it's not a pleasant situation to be a Jewish student in some campuses these days, or to be a Muslim student in some campuses, but no problem as well. So I don't think there's a perfect answer. We're not going to solve it overnight. It's going to take some time for all these colleges to kind of figure out what the right balance is.
Do you get a sense that there is something specific that people are asking for that goes beyond a statement on anti-Semitism or Islamophobia and goes more to the nature of conversation at certain universities?
Well, at certain universities, I would say on the far left or far right, there's not a lot of room for people who disagree. Some campuses are far left, some are maybe more conservative, and people who disagree with the conventional or the majority view don't get the kind of support that they might want to receive from the college presidencies or universities in some cases. Harvard is seen by people in Congress who said yesterday in the hearing that it's seen as far left. Maybe it is, maybe it isn't. I was on the board of Harvard for many years, and I think Harvard tries to do the best it can, but it's a very large campus, very diverse. The president of the university has done as good a job as she can in a very short period of time dealing with these issues, but nobody is going to be able to solve this problem overnight.
You're also on the University of Chicago board, and full disclosure, I attended there, so if I'm biased, I just want to be completely transparent. There is this question about whether it's appropriate for a university to take a stand at all on any social issue, or just to let the individual professors and students have their own voices rather than have some sort of collective voice that you have to stay within. Do you think that that is the way to go?
Well, it's the same issue CEOs face. Should corporations be taking positions on these kind of issues? Sometimes they do, sometimes they don't. Universities are places where young people are generally allowed to grow and experience what life is going to be about when they leave campuses, and they tend to be sometimes more shrill in certain things they might be when they become an adult. I think at the University of Chicago, we've had a long-standing 100-year policy of basically letting people say what they want, as provided that they don't do anything that harms anybody else or incites violence. But there's been a lot of free speech at the University of Chicago, and I think that's a great tradition there.
Do you think that going forward there's going to be any change in response to some of the pressure from
given the pressure that we have seen now, I suspect something will happen, but I don't know that Congress will do anything. I think the university boards are probably going to be more sensitive to these issues. There is going to be more security for certain students there for sure, but I think there'll be more of a move towards a University of Chicago approach where more people are allowed to say what they think without feeling that if they say something that's unpopular, they'll be criticized or harmed physically.
Just besides this particular issue with Bill Ackman, he's also been vocal about investing in treasuries, just to shift a little bit to the investment side. And I am curious if you're starting to hear this more, that certain hedge funds that maybe are struggling to get an edge in public markets are just making bold trades on the path of interest rates. How much are you hearing that?
Well, Bill Ackman said in the interview was that he generally doesn't make big macro bets. That's not what he generally does. He generally makes bets on companies. But in a couple of times in his history, he has made macro bets, and some have worked out extremely well. And he's made one not too long ago where he made a couple $1 billion, I guess it was a $2 billion profit on a relatively modest investment in a relatively short period of time. That's hard to do. This time he's made a bet, in effect, that the Treasury rate will go down, or the interest rate will go down. The Fed will lower interest rates sooner than the conventional wisdom thinks. And I assume he's structured it so that if they do, he'll make a fair amount of money.
And I'm assuming that right now he's pretty happy with what he's seeing because the market's coming along to his view.
The conventional wisdom today is that the Fed is likely to cut interest rates sooner than maybe people thought a month ago. Right now, I think the Fed doesn't want to get into the election season, so if they're going to cut rates, they're probably not going to do it too close to the presidential election, so they probably would have to do it sooner.
Meanwhile, just want to bring this to you, just breaking, Citigroup is reporting some figures and what they expect, and they say that fourth quarter trading revenue is expected to drop 15 to 20% compared to the third quarter, and you can see, as the CFO does talk, you can see shares falling. This really does speak to this sense that there isn't going to be the same kind of opportunity to make profits for some of these firms as there has been earlier in this year, that basically this is what they're going to pitch when the CEOs go down to Washington, D.C. and start saying, you know, maybe we earned record profits, but we're going to lose it to people like you, David Rubenstein at Private Credit and Private Equity. What do you make of some of these arguments?
I'm not worrying too much about the large banks. They can take care of themselves. I'm sure they'll do well when interest rates go up or down. There's no doubt when interest rates go up, they tend to make more money historically. If interest rates go down, they're very smart. They'll find other ways to make money. Private equity firms and private credit firms have done quite well generally over the last 10, 20 years or so, and we have a lot of very smart people. We'll try to figure out how to navigate whatever interest rate environment we have.
David Rubenstein, it's always a pleasure. Thank you so much for being on.
My pleasure. Thank you.
Meanwhile, we are seeing a bit of a move in terms of Citigroup shares. David Rubenstein of the Carlyle Group. He is host of the David Rubenstein Show, peer-to-peer conversations. It is always a wonderful watch. Highly recommend this Bill Ackman interview. You can watch it on Bloomberg Television at 9 p.m. Eastern tonight. Meanwhile, we are parsing through economic data, the drumbeat to Friday, given the fact that we are expecting some sort of significant market response. We are parsing into the ADP numbers, and we are seeing a greater move. Michael McKee, Bloomberg International Economics and Policy Correspondent, here by my side. What do you see that might be giving a bit of a pop, further pop to these markets?
Well, certainly a big pop in the equity markets after the productivity and unit labor cost numbers came out surprisingly high. Now, we knew growth was strong in the third quarter, but productivity comes in at 5.2%. The estimate was for 4.9%. And unit labor costs, which had fallen 0.8%, in the last quarter, down 1.2%. Now, this is at a time when we have been hiring a lot of people, which would, in theory, put some downward pressure on those things. And so it does suggest that we're going to see additional possibilities for corporate profits from the third quarter and into the fourth quarter. And so we're seeing a reaction in the equity markets, certainly. And you also get a little bit of a reaction in the bond markets because it makes the Fed's job easier to cut rates if we're seeing productivity gains.
Do you get a sense of where the bias is right now in terms of weaker than expected data will be welcomed as actually a good thing as long as it's not too weak? That's actually what people seem to be looking for to continue this Goldilocks.
Yeah, well, it reinforces the mood and the mode on Wall Street right now. The old saying is that the Fed raises rates and the markets cut. And the markets are in cut mode right now, and it is, as David just said, simply a question of timing. And you do have to throw in, I guess, the politics of it to a certain extent. But the way things are going right now, it does look like the Fed could be cutting by mid-year. I don't know if I want to go as far as saying the first quarter because they don't want people to think that they're declaring victory too early. But all of the numbers seem to be good news in the sense of confirming kind of a soft landing.
Just taking a look within the ADP payroll number, you're seeing 5.2% non-farm productivity versus 4.9%, as Michael was saying. And the fact that unit labor costs went down by 1.2%, more than expected, just highlights exactly that sort of perfect situation. Just quickly, we don't care about trade balance at all? Do we care at all?
Trade balance is a revision to the number that initially came out, and it's very, very small. So it's going to subtract a little bit from third quarter growth probably, but not, actually fourth quarter growth, this is October number, but not a big deal at this point.
Michael McKee, always wonderful to get your insights. Michael McKee of Bloomberg. As we do drumbeat into tomorrow, into the initial jobless claims, and then going to Friday and the non-farm payrolls report. Coming up later today, Lisa Su, AMD Chief Executive Officer, on the chips backdrop at a time of increasing competition and demand.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg. Context changes everything.
I'd like to kick off with a very simple question. Has the whole Brexit process been messier, less messy, or as messy as you expected way back in 2016?
Was it as messy as we thought it would be? Probably was, and I tell you why, because of the fundamental mismatch between, if you like, rational policy in the UK and what was, in a sense, performative ideology in the UK. And I think that was the problem. We could have had the deal, the so-called Windsor deal, several years ago, but the Johnson government simply did not want a deal on those terms.
But I think for the short to medium term, the next 3 to 5 years, the Brexit will be net negative on the UK economy, no question about it. What happens over the longer term depends on what the British establishment or the future UK governments do. One, I do think ultimately they will finish up in the next 10 or 15 years putting some kind of, I call it a trade deal with Europe similar to Norway or Switzerland. I disagree with Declan. I think they will pay into a European budget. I think they will have no choice. It is too big. The fundamental strength of the single market is something that is too attractive for the UK economy to be excluded from.
Maybe the messier part is yet to come.
What do you worry most about your economy in Greece? When you look at tourism, it's booming, but it also means some of the islands are overcrowded.
Exactly.
Is there something that you can do about that?
Thank you for asking this question, because I want to make sure that, in 5 years from now, we will not have sacrificed, the beauty of our sort of natural environment at the interest of a very rapid growth. So that's why I'm really focusing on sustainable growth. That's why I will always push for quality over quantity. Very strict in terms of standards. We are actually looking at our local and regional sort of planning legislation across the country to make sure that we know exactly what we can build and where we can build it. There are parts of Greece which have reached saturation point, and if we have to place restrictions, we will, in order to protect, especially islands, which are more sensitive.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
2 days without gains on the S&P 500 for the first time since October. We're trying to do something about that today. Equity futures positive on the S&P by 0.4%. Live from New York City this morning. Good morning, good morning. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Live from New York City, coming up, transatlantic rate cut bets piling up. The appetizer for payrolls coming in soft, and Wall Street bosses heading to Capitol Hill. We begin with the big issue. Has the Fed put made a comeback?
The Fed put is back. The Fed does have a loaded gun that they can use as needed and as appropriate.
I'm not worried about or need a Fed put.
The Fed put is always there. It's just a question of what is the strike price.
Fed's actually done a really nice job of maintaining higher rates.
The inflation numbers will support that the Fed can back off.
Inflation coming down does increase their degrees of freedom.
And this idea that the Fed's going to slowly kind of cut rates as inflation's heading lower.
To truly deliver 120 basis points of easing without economic weakness and just inflation remaining somewhat above trend.
This is not what the bond market is pricing in for.
That might be too aggressive.
The CPI numbers year over year are going to get tougher for inflation to show continued improvement.
It's going to take time before we get inflation under control.
We'll have to see next year. That's the question of a Fed put.
Let's get into it right now. Joining us is JP Morgan's AJ Oden, Morgan Stanley's Dan Skelly. Gents, let's start with this big question. Dan Skelly, is that Fed put back?
Jonathan, good morning. Listen, we think the Fed is going to be in place to start cutting rates in June of next year, and that presumes a slowdown from unsustainably red-hot growth over the past 6 months or so. And yes, inflation on its way to 2%. Do you get exactly to 2%? No, you can't, because you're still in this post-pandemic paradigm of tight labor, of labor shortages. You have tight housing supply. And so you can't get exactly there, but you're on the path. And the reality is you've seen enough cooling in the last month or so in the labor market to suggest that you are seeing a slowdown in growth. and that you need to be in position to cut rates where appropriate. So we wouldn't exactly call it a Fed put, but we think it's going to be appropriate to start cutting mid-next year.
Jim Zauter, Apollo, higher rates are a loaded gun to use if needed. AJ, do you agree with that?
I think that what we've seen is moderately slowing growth, and ultimately we've seen inflation start to trend lower. And so being that the Fed is, on their way to that soft landing, that does give them the opportunity to cut rates in 2024 as we start to see inflation come down without significant easing in the labor market, cooling or too much cooling in the labor market. So to me, it does make sense that they've given themselves enough room to cut. And, we've had rates in restrictive territory, above headline inflation for some time. So it does make sense that in 2024, we'll actually start to see them do so.
This is the question, isn't it, AJ? Is inflation low enough for the Fed to offset material weakness? Most people think it is. Going into next year, I've got some big calls, AJ. I've got Deutsche Bank saying 175 basis points of Fed cuts. It starts in June. It's coming next year. On the ECB, they say 150. This market's already pricing it. AJ, when you start to think about what they're going back to, how deep are those cuts going to be?
Well, it's interesting because it's going to get tough from here from the Fed. I'm not going to lie about that. And to be honest, what's going to happen is when we start to see the soft landing come into play, it's going to look a little bit like a recession in some areas just because of the fact that it's only going to get harder. You're trying to navigate the economy into a soft landing, and ultimately, trying to do so is going to be a little bit difficult. But from here, right now we've seen about, a little bit over 100 basis points of cuts priced in, and only if we start to see more significant weakness to the point where maybe a negative non-farm payroll, then you start to see potentially more cuts from the Fed. But as far as what we're seeing right now, and we'll get another SEP from the Fed likely soon, everything seems like the market is priced in that, they're on their path, and that's why we're seeing this optimism and exuberance in the equity markets.
Dan, I get that we all want to talk about the next 6 months, the next 12, the hard landing, soft landing debate. Can we talk about where we are right now? I've talked about this all morning. Can the growth inflation mix get any better than it currently is at the moment, Dan Skelly?
No, we've been handed a set of holiday gifts here, Jonathan, frankly, and it appears that Santa did come early this year, right, with this big November surge in equity prices and, frankly, in bond prices as well, after both had been, beaten down this summer. But no, I think you're right. We've seen really the perfect mix of slowing economic data, but not recessionary magnitude, as well as this slowdown inflation. So, we agree. We think you have been handed a gift. And now as we go into 2024, it's going to be way more idiosyncratic biased. It's going to be way more bottom up and actively biased than just trying to repeat the magnitude of the index level returns this year.
It was captured beautifully in the ISM yesterday. Headline number, robust. Beneath the surface, what did you see? You saw prices coming down, job openings, the lowest since spring of 2021. Just all great stuff. So, Dan, you've got a short-term call then, I assume, and you've got a longer-term call. Can you help me understand both?
The short-term call is that we've had a massive move, Jonathan, off the October lows. And the whole notion that rates don't matter for valuation, which was obviously incorrect this summer as the long end touched 5 and the S&P retraced 10% lower, was also disproven again to the upside, right? As rates came back down closer to 4 today on the long end, you've had this big move upward. We think you've gotten, Jonathan, the lion's share of the contribution and support from rates in the near term, right? We see rates continuing to drip lower from here, but not having a huge step function lower. And so with that, again, multiples have expanded at the index level to 19 times forward. This is going to be from now on out looking at more idiosyncratic sector and stock ideas. And on that note, finally, longer term, Jonathan, to your question, we think the key underpinning theme of this cycle is productivity. Right? When we think about AI at its essence, that was the big breakthrough headline this year, obviously, and performance trend this year. But AI essentially is the combination of high cash flow business models and unique data sets. And at that essence is productivity. And so when we look underneath the surface at other sectors, other industries, other trends, we want to be focused on those two variables across all stock picking opportunities into next year and longer term.
We'll get to those ideas in just a moment. More specifically, let's talk about this broader market price action right now, about 25 minutes away from the opening bell. Equities near session highs here, up 0.4% on the S&P, up 0.7 on the NASDAQ 100. A turnaround in the bond market this morning. Let's sit on that for a moment. Yields were higher, Now they are lower on a 10-year, down 2 to 4.14. Mike McKee, the ADP report. We played this game a million times over the years. We talked about it this morning. It doesn't matter, and then apparently it kind of does.
No, not today, John. The numbers that really matter, I screwed up. I didn't put them into a chart for this hit here because I didn't know they were going to come in the way they did. But Dan Skelly really nailed it. It is productivity. Productivity comes in up 5.2% in the revision to the third quarter, and unit labor costs fall 1.2%. That is both a sign that companies can be more profitable and that the Fed could cut rates with a little less concern about inflation coming back. Now, we knew the third quarter was going to be strong, but we didn't know it was going to be this strong. So that's the last minute change in market thinking this morning. ADP, as you mentioned, comes in very low, 103,000, but it doesn't have a great track record in predicting, and they say they don't. So let's spin ahead to Friday, and what are we looking for? Well, the forecast for November is 187,000, according to economists surveyed by Bloomberg, up from 150. The October UAW effect, 35,000 manufacturing jobs were off, and they're expecting 30,000 of those to come back. ADP saw a loss of 15,000 jobs, so that will be interesting. Whisper number, we talked about 157. The 6-month average, 206. Unemployment not supposed to change. October earnings were coming down. November is forecast to come down again, and that's kind of the story going forward for the Fed. If productivity is rising, companies can give raises, but are they doing that? If they're continuing to cut back, that's good news. The Fed looks for 3 to 3.5%. Right now, we're looking at a 4% year-over-year number for November. So that would continue this whole soft landing narrative, and markets are probably going to react to that in a positive way.
Mike McKee, thank you, sir. Dan Skelly, is that the data you were looking for?
It's exactly what we were looking for. So, we're pleased to see that. But, John, this is just the early innings of what's going to be a longer-term structural trend over this decade. And if, again, you think about some of the themes my colleagues at Morgan Stanley Equity Research has talked about over the last 5 or 6 years, again, AI was a big headline driver this year, but we as a firm have been talking about this concept of tech diffusion across many parts of the industrial world, many old manufacturing business models, and frankly, other sectors like healthcare, right? So this theme in terms of tech diffusing other sectors and making other sectors more productive, this has been permeating, it's been sowed for several years. And we're, again, frankly, just in the early innings of this.
AJ, we do this every month. I'll put the productivity data to one side. Let's just talk about the ADP report briefly. Downside surprise, 103. Estimate was 130. Previous number, a revised 106. AJ, how useful is that number for you looking ahead to payrolls in a few days' time?
I mean, we really, it's the Friday numbers are going to matter a lot more. I think with ADP, it sort of gives the market a potential indicator. But honestly, the Friday numbers are what we're really going to be looking forward towards. And I think we're expected around 187. Now, the Fed typically pauses around that, 177 or 170 mark. And I think we're already there. I think we've already seen the pause. We've seen that rates are actually bringing inflation moderately down. And now we're looking at, okay, well, where will we start to see cuts? And we believe those are going to happen in the second half of next year. And so I think when we think about these, the fact that the labor market is still significantly tight, the ADP number is just sort of the early indicator to the potential what we'll see on Friday. But the Friday number is really what matters.
AJ, I hate to ask this because a lot of people are frustrated by this question, but we've got to ask this. Is bad news on Friday, or is bad news good news?
That's a great question, John. I think right now we're still in the bad news is good news. Obviously the exuberance that we've seen in the market, we're up almost 20% on the S&P 500. We're still recovering. We haven't really got back to the highs. I think next year we'll see the potential for the S&P to get to all-time highs, but at some point we will inflect and we'll get to the point where bad news becomes bad news again and the market starts to consider, are we in a recession, right? I mean, we're talking about slowing growth, sub-trend growth without actually seeing significant rise in the unemployment rate. And as we start to see, the non-farm payrolls potentially get to, negative at some point, if even at that level, the market's going to start to wonder, okay, well, is this a recession? Is a recession on the horizon? And we haven't completely taken the recession risk off the table. We still believe it's out there. Our base case is just for a soft landing, and that's what we're seeing right now. And so at some point, the market will turn a bit, and I think that'll be great for bode well for bonds. I think either way, investors should lean into adding duration. We're seeing these yields at levels that we haven't seen in some time, obviously since, around 2007 or 2008. And so it makes sense that if the Fed is going to cut here, whether or not it's a soft landing or a recession, investors should definitely lean in. Now, good news is bad news. Like I said, I think ultimately right now we're still in the good news is bad news and less of the bad news is bad news part of the market.
I'm confused already. Dan Skelly, you don't escape this question. Which one is it?
John, listen, the news isn't going to be that bad. Let's face it, when you look at both weekly high-frequency jobless claims and continuing claims, you're just not going to have that big of a fall off in jobs this Friday. So it's probably going to be more in line, right? And so if it's in line, can you say it's marginally bad relative to expectations? Maybe, but I don't think you're going to see a big market swing one way or another. Importantly, John, just getting back to my comment a minute ago about tech, let's think about it. One of the deepest labor cycles we had a year and a half ago was from the tech sector. And I think the irony here is if you think about the skills and the demand for tech and coding and other sectors like I alluded to, these are some of the most marketable people in the employment world. And so I think they're being absorbed more quickly in other areas of the economy.
Dan Skelly, AJ Oden, sticking with us. Futures, session highs on the S&P 500 up by 0.4%, on the NASDAQ up by something like 0.7%, with some movers going into the open. Here's Abby.
Let's start out, John, with what is helping the stock market trade higher here in the pre-market. And of course, NVIDIA, the chip maker giant, it is popping. This on comments from CEO Jensen Huang saying that the company will in fact be able to deliver AI chips to China that are in line with U.S. restrictions. In other words, the market, China, remains viable. AMD also higher ahead of its 10 a.m. AI event. Always comes back to AI for these chip makers at this point. And of course, CEO Lisa Su is joining BTV later today. And then Citigroup fluctuating, but well off the lows. At the lows, it had been down at almost 3% after CFO at the Goldman Sachs Banking Financial Services Conference, Mark Mason, said that trading revenue will be down 15-20% on a quarter-over-quarter basis, but investors are reconsidering and now about flat.
Abby, thank you. More from Abigail around the opening bell. Coming up on this program, Donald Trump skipping yet another GOP debate.
We also have someone else that's on the ticket that it really ought to be on the debate stage, because otherwise this is just a candidate forum and not necessarily a presidential candidate debate.
Republicans squaring off in Alabama as President Biden ramps up fundraising efforts. That conversation up next.
What did you learn in the last 40 years about leadership in politics?
Well, I've been learning a lot about leadership for a very long time, observing it in others, recognizing what is needed to get the job done. And I always define it in this way: know your why. You have to know why you're doing this, because you will be under attack, this for sure. Know your why, know what you're talking about, know how to get it done, think in a strategic way, and then that's all up here. And then also connect directly with people. If you can show them how important what you're advocating is and what you know you're talking about, so they trust your judgment, and you have a plan, you will have followers. You will be a leader.
This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to The Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
We also have someone else that's on the ticket that it really ought to be on the debate stage, because otherwise this is just a candidate forum and not necessarily a presidential candidate debate. But the problem with all of this is that the longer we wait to make the decision, the harder it will be to compete against the former president, and that's what's going to make this most difficult. More and more people are lining up behind Nikki Haley. They like what she's saying. They feel they're good about the way she's doing what she's doing.
4 candidates qualifying for tonight's GOP debate, and once more, the party's frontrunner not making an appearance. The former president, Donald Trump, instead speaking at a Fox News town hall last night.
Day one, the border gets closed, and day 1.5, we drill. You know, we drill, baby, drill, 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 drill.
Meanwhile, President Biden raising eyebrows, suggesting he may not have run for re-election if Trump wasn't doing the same. Biden later downplaying those remarks.
Would you be running for president if Trump wasn't running?
I expect so, but look, he is running, and I have to run.
Would you drop out if Trump runs out?
No, not now.
AMH joined us in Washington, D.C. Anne-Marie, does that clean that one up?
Well, we know he is running, and he is, of course, going to be the Democratic nominee. As of now, Jonathan, I mean, things could, I guess, potentially change. It is going to be an interesting year. But, you know, Biden is going to be the nominee when it comes to Democratic Party. But he fed into this anxiety that we've seen in poll after poll of American voters who are concerned about his age at this moment. He is the oldest U.S. president in American history. And here is what he was cleaning up. If Trump wasn't running, I'm not sure I'd be running. But we cannot let him win for the sake of our country. Now, you talk to people in the Biden world, and they say that this isn't really new for Joe Biden. This was the reason why he got into the race in the first place, why he originally wanted to run, because he thought the former president's remarks when it came to Charlottesville were abhorrent, and he felt like he had this duty to the country. But of course now, as I said, he's feeding into some of those concerns as we go into this election. 4
on the stage tonight. Talk to me about how quickly you expect that 4 to become 1.
Well, it's potential that these 4 are going to really go for it when it comes to Iowa, New Hampshire, and then potentially, Jonathan, some of them will drop out. But of course, to Lisa Camuso-Miller's point last night, this is more of a candidate forum because the front runner will be missing tonight. And instead, he did a 1-hour interview with a live audience, a town hall style, with Sean Hannity last night. And he's not going on that debate stage. So it's not a full Republican presidential debate because the front runner is missing. But we should note there is a lot of momentum behind Nikki Haley. All eyes are going to be her on this evening. I mean, just this week, she brought in $250,000 to her super PAC from a Democratic donor, Reid Hoffman. So tonight will be interesting. It's a race for second place.
Amazing. AMH, thank you. On the latest down in Washington, looking ahead to the 4th GOP debate. With us for a final word, AJ Oden, Dan Skelly. Dan, we've got to talk about it next year. How relevant is politics for your call?
John, one of the interesting things about this recovery post-COVID has been the bifurcation in the high end and the lower end income consumers, right? More recently, gas prices having sold off have helped everyone, but there's still been this pretty big divergence between the wealth effect of the high end who have big investment gains, solid real estate asset values, and the commensurate spending on services and travel and hospitality, and everyone else. We are seeing a slowdown in the low end, particularly because of inflation, and delinquencies are rising in credit. Having said all of that, Jonathan, the high end, which has buoyed the overall environment, does pay a lot of attention to politics. We actually just saw in our Morgan Stanley Research Consumer Survey this month that the number of folks citing policy and politics as a concern went from 30% a month ago to 45% this month. So it is something we are focused on, and it could potentially be an overhang in the second half of next year.
AJ, do you agree?
You know, when we think about politics, when it comes to investing, when we tell our clients that, you know, regardless of who is in office, markets tend to rally. I think that you can obviously try to, when you dig into policies, you can try to figure out what, you know, what sectors or individual names may outperform depending on what their overall outlook is. But ultimately, you know, just staying invested for the long term is really what makes the most sense. And right now, what we're really talking about and what we're excited about is technology, especially with AI, seeing that potential productivity gains could mirror what we saw in the early tech cycle back in the late 90s and early 2000s. So for us, it really is an opportunity to get in at this attractive entry point. Although valuations for some may seem relatively expensive, when you think about the fact that we're coming out of that earnings contraction and actually seeing earnings growth, and the fact that many CEOs are talking about the potential to invest and build on to their offering and adding AI overall, and that creates an opportunity to lean into technology, which makes up a significant amount of the S&P 500. So for us, looking at the election, it's really just about staying invested, regardless of who's in office.
AJ, thank you, sir, for your perspective. AJ Oden there and Dan Skelly. Gents, thank you very much. We are about 8 minutes away from the opening bell. Equity futures positive by 0.5%. In about 8 minutes' time, you'll hear some opening testimony on Capitol Hill. There is a Senate Banking Committee hearing with Wall Street's biggest bosses. Sonali Basak on the ground for us. Sonali just tweeting this moments ago. The big bank CEOs have entered their waiting room before hours of grilling in the Senate, going on to say it sounds like a full-blown party in there. I was told by one senior exec that this time they're excited. They're building their case against more capital rules. That room will come alive in about 10 minutes' time. We'll bring you some coverage of that in just a moment. Coming up, the morning calls and later, the outlook for the Federal Reserve. SocGen Sibaja Rajappa expecting to see rate cuts midway through next year. That conversation about 7 minutes away.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader. Yeah. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
In many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal. Now, more to the point.
What is the lesson or the observation?
Jobs data a little softer, productivity data a little better, equity futures positive by 0.5% on the S&P 500. That's the price action. Let's get you some morning calls. Your first call from Wedbush, downgrading Shopify to neutral, $68 price target, highlighting the stock's premium valuation. That stock is down 1.6%. Your second call from Bank of America, downgrading PayPal to neutral, expecting limited upside next year as new management gains credibility. That stock is just about unchanged. And finally, Raymond James, upgrading Shake Shack to a strong buy, seeing opportunities to improve margins and cut expenses, up there by 4.2%. Coming up on this program, SocGen Sibaja Rajappa expecting a 3 handle on a 10-year. That conversation coming up shortly. Equity futures session highs, your opening bell just around the corner.
CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact the business and steer the direction.
We are like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. A new episode every month, only on Bloomberg.
Following on X, or what used to be called Twitter.
Sure.
Is that a plus for your business or a minus for your business?
At worst, it's neutral, but probably no one's going to want to have a proxy contest with someone with 900,000 Twitter followers.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
The equity bulls have been absolutely spoiled. We've had 2 days without gains on the S&P 500 for the first time since October, and we're bouncing back already, up by 0.5% on the S&P, on the Nasdaq firmer by 0.8. Jobs data, ADP, for whatever it's worth, coming in a little bit softer. Productivity better. Yields lower, stocks higher. Later opening bell, switch to the board and get to the bond market. Yields look like this on a 10-year. Break of 420. A break of 420. We add to the move. We're down by 2 basis points. 414.58. In the FX market, the euro just a little stronger. 108.02 on euro dollar. Big call in the last week. This morning, we heard from Deutsche Bank. They're saying 150 basis points of cuts from the ECB next year. That's basically in line with market pricing. The call that we had in the last week came from Jeff Yu of BNY Mellon, who's looking for parity on the euro. Parity, we're at 108 right now. Crude, 70. We're just about lower by 2.3% on WTI. About 35 seconds into the session shaping up as follows on the S&P 500, firmer by 0.5%, on the Nasdaq up by around about 0.6. The one stock to watch at the open is Apple, the tech giant reaching a $3 trillion valuation for the first time in several months. Abby has this one. Hey, Abby.
Hey, John. Yes, Apple 3T is back. The last time we saw Apple cross that threshold was back in July, when we were really in the throes of the bull market for technology. And yesterday, Apple closed up, outperforming the market broadly by about 2.1% on the day. And the news that seems to have put Apple above the $3 trillion mark is a positive forecast from one of the iPhone assemblers. Specifically, Hanhai Precision gave a better forecast. Now, investors are assuming this reflects demand from Apple, and Citi is saying it probably is a positive for Apple because 50% of Hanhai's complete total revenue is coming from Apple. Now, what this could mean going forward, when Apple was around the $2 trillion market a couple years ago, it took 8 months for Apple to really punch through. It basically wrestled with that mark for a while. We're about 5 months in. History, if it's a guide, suggests that Apple will at some point really clearly be through the $3 trillion mark. We just don't know if it's right now. And of course, as Apple goes, the market goes. So at some point, this does seem like it's probably bullish news for the markets, John.
194 this morning, firmer by about 1/3 Abby, thank you. Let's turn to Boggs, the company trimming its outlook for 2024. Isabel Lee has the story. Hey, Isabel.
Hey, John. It's really the tepid revenue forecast that spooked investors. The company posted adjusted profits that fell short
of Wall Street's estimates and also posted a 2024 outlook that was also really low. They trimmed it by a lot, citing macroeconomic pressures on some of its businesses. And as you can see, shares are down almost 11%. In pre-market trading, it was down by as much as 13%. So Box came out with quarterly earnings of 36 cents per share. That's 2 cents lower than estimates. Revenue was also lower than estimates. Citi called the report noisy, while Morgan Stanley called it messy. There are many reasons for this. Among those is the fact that a third of Box's business is done outside of the U.S. That's how they generate their revenues, and 60% of that is in Japanese yen. And as we know, that currency is among the worst performers year to date. And of course, there's also softer demand ahead of the year when people are expecting, some at least, a recession in the horizon. So far, year to date, Box shares are down by 14%, John.
Tough morning for them, that's for sure. Isabel, thank you. Let's turn to the tobacco industry. British American Tobacco writing off about $30 billion worth of U.S. cigarette brands. Alex Semenova joins us now for more. Hey, Alex.
Hey, John. Good morning. It's a tough morning as well for cigarette companies, including Altria and Philip Morris, which are trading lower today in sympathy after British American Tobacco downgraded the value of some of its U.S. Cigarette brands by nearly $32 billion. Big write-down there. It also downwardly revised its 2023 revenue forecast to the low end of its prior range. Some of those names from British American Tobacco include Camel and Newport. Morgan Stanley called this disappointing. They said that it underscores the challenges that the U.S. cigarette market is facing, even as they try to move from cigarettes to vapes and other products. Jefferies analysts, on the other hand, said that there are reasons that this isn't too negative. They underscored profitability in its vaping business, saying that that is one of the bright spots here. But you could still see that pressure in Altria and Philip Morris this morning. John?
Both names trading lower in early trading. Alex, thank you. Altria down about 3%, Philip Morris down about 2.4%. Let's turn to the home builders. Toll Brothers reporting weaker than expected quarterly orders. Simone Foxman has this story. Hey, Simone.
Hey, John. Yeah, they were weaker than expected, but not by much. And Barclays says that this is what Wall Street was expecting. They were expecting weakness in the quarter, ended in October, largely attributable to higher interest rates. And so something roughly in line with expectations across the street is probably going to be well received. We are seeing that good reception in the market today with shares up over 3%. Also, earnings per share coming in ahead of expectations, $4.11. The street had been looking for $3.72. But, you know, the bigger move here, maybe that all indications are that the next year, which just began on a fiscal basis, is going to be much better. 2024 forecast was higher than most anticipated, up to 10,350 new homes. That's well higher than the 9,600 homes delivered in the 2023 fiscal year. Douglas Yearley, the CEO, talking about solid demand in the first 5 weeks of this quarter. Resale inventories as well at historic lows. That's driving buyers to these new homes. Bloomberg Intelligence also made an interesting point. They said that Toll Brothers is not aggressively offering incentives, and that's what it's allowing it to keep its margin up around 28%. When you look at the margins for some of its rivals who are not as much in this luxury business, you're looking at Lennar around 25, D.R. Horton at about 20%. We're seeing earnings. We saw 87.78. That was a record on Friday for this share, but we're well higher than that. So this is an all-time high for Toll Brothers stock, John.
They're nice buildings. I've seen a few here in New York City. Very luxurious. Simone, thanks for the update. That stock is trading firmer. Got to do a couple of things this morning. Let's start with the price action. About 6 minutes into the session, we're positive by 0.4% on the S&P, up as well on the Nasdaq Composite and the 100 as well. Coming up at the top of the hour, the Q&A should begin on Capitol Hill. Let's take those live pictures right now. What you're seeing at the moment, opening statements just about beginning on Capitol Hill from the Senate Banking Committee, taking on some of the biggest CEOs on Wall Street. This is about a push from policymakers for higher capital requirements. The focus of the bank CEOs, they're going to talk about why this can transfer risk to private markets. They'll underline why they think that's risky. Others think it's not. Their ability to finance the economy, they're going to ultimately say it might compromise it. There's this quote coming into it, already released by Jamie Dimon at JP Morgan. Banks would be limited in their ability to deploy capital in the times we're most needed and the rule will have a harmful ripple effect on the economy, markets, businesses of all sizes, and American households. I think you know how this is going to go over the next couple of hours. So this is what we'll do. These are the opening statements. Once the Q&A begins, probably in about 20 minutes' time, we'll take that live right here on Bloomberg TV for you. And in just a moment, a preview from Bloomberg's Sonali Basak on the ground, together with Katie Lyons down in Washington, D.C. All of that still to come this hour. Let's go turn back to this market and get to bonds specifically. SocGen Subhadra Rajappa weighing in on the year ahead, writing this. The question as to whether the Fed will be able to orchestrate a soft landing in 24 is front of mind. Our economists are calling for a mild recession by mid-year when the Fed will likely pivot to easing. Subhadra, I'm pleased to say, joins us right now. Subhadra, great to catch up with you. Let's get into the language there. Cuts. Is it easing or a return to neutral? What is it?
It's easing that's going to ultimately return to neutral in 2025. So for 2024, we have 150 basis points of cuts penciled in, but we expect more cuts to come in 2025. The economy, broadly speaking, is softening very gradually, and the easing of financial conditions just in the last 4 weeks is really helping the Fed perhaps be a little bit more at ease heading into the December meeting, given the fact that the data has also been softening ever so gradually in the fourth quarter.
Let's drill down on that, Subhadra. I started this conversation at the top of the hour with some equity investors, and we talked about whether the Fed put was back. Given how much inflation has come down, how much space do you think there is for this Federal Reserve to respond to adverse shocks? What are they going back to?
I think they have a lot of ammunition this time around than any time in the past to be able to respond to adverse shocks, because they've raised rates quite dramatically and inflation's been coming down very gradually. We have core PCE around 3.5%. Core PCE probably declines to around 2.5% by the middle of next year, which is when we have a recession penciled in. And at that point, if you look at policy around 5.5% in Fed funds rates, it's going to be quite restrictive. So the Fed's got a little bit of room in the middle of next year to cut rates. And I think that that's a very unique and good situation to be in for the Fed.
So your call is 150 for next year, right? 150 basis points of cuts, Subhadra, is that right?
Yes.
You've been saying for a while that risks are skewed asymmetrically to lower yields across the curve. Now, that was on the 10-year. I want to know if it is across the curve now, given what we've seen develop in the last month or so.
It has been actually across the curve, and that's part of the reason why we've always held the view that the risks are asymmetrically skewed to the downside, even in the 10-year. I mean, our economists had a recession penciled in for early 2024. We never had a recession penciled in for 2023. We've kind of pushed out that timeline to mid-2024, and we've always had about 150 basis points of cuts for 2024. And in that sort of context, that's part of the reason why I thought 10-year yields had more room to decline. I mean, when we put out our forecast for 2024 in early November, or actually even before that, I mean, 10-year yields were at 5%. So 375 in 10s by the middle of 2024 seemed like a distant dream, but we're pretty close to there already.
Not far off right now. For those just tuning in, we're at 415 on a 10-year at the moment. And to your point, Subhadra, this has turned around so quickly. It was only back in October we were talking about north of 5, the problems with the deficit. Walk me through why from here you don't think there's that much more downside still to come. Is it the deficit, other forces, other dynamics you think will persist into next year and beyond?
Absolutely, John. You hit the nail on the head. It's the debate and the discussion we've been having over the last couple of months with just more supply hitting the bond market, the rebuilding of term premia, and the supply-demand imbalance, which is very much in play still. I mean, we're expecting more increases to coupon issuance sizes at the next refunding meeting. So for the most part, you're looking at a picture that's not very different on the supply-demand aspect of things, and I think that's ultimately going to lead to a build-up in term premia in the very latter half of next year when we get through a recession. So higher yields will ultimately prevail, but over the next sort of medium term, we think lower yields are very likely.
Help us with the shape of the curve, Subhadra. Is this classic sort of bull steepener going into the end of cycle? Is that what you and the team are looking for now?
Yeah, I mean, we were expecting sort of a bull flattener initially with the front end peg to Fed expectations, but the market's been very, very quick in pricing in nearly 6 cuts for next year. So the front end has also rallied, but I think that eventually you're going to see a lot more room for the curve to bull steepen into the middle of next year.
Interesting. Subhadra, appreciate the update. It was quite the call originally, and now it looks like almost consensus because it's just around the corner. Things move fast in this bond market. Subhadra, thank you. Subhadra Jaffa there at SocGen, looking for lower yields, but ultimately not much lower than where we are right now because we've dropped to 4.15 from north of 5% only in October. The broader equity market, about 12 minutes into the session, we look like this on the S&P 500, up by 0.4%. On the Nasdaq 100 there, up by 0.3. The Russell, the small caps, we've seen some big moves there. The Russell up by 0.8%. Coming up on this program, big bank CEOs head to Washington.
It's good that we're having these hearings on Capitol Hill. We had one on our side of the Capitol a few weeks ago. People were really dissecting the Basel endgame to see what we should keep and what we should reject.
The grilling and the pushback beginning on Capitol Hill. That conversation up next.
To the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg. Context changes everything.
Whether you realize it or not, your music taste is already partly dictated by artificial intelligence. But what if I told you some of the music itself was made with AI? Would it change how much you enjoyed it? It's worth thinking about because it's happening, sometimes illegitimately as well as legitimately. Grimes, for instance, lets people use an AI version of her voice to fabricate new songs and split the royalties 50-50. Purists look down on artifice within artistry, but are AI-generated vocals any less creative than organic voice run through auto-tune or layers of effects? Because trust me, most pop is processed in some form, even if the singer can hit the right notes. More interesting, I think, is the idea of training AI on the work of the dead in order to keep releasing their music for the living. Again, this is already happening. Hundreds of thousands of fans have listened to the late Linkin Park singer Chester Bennington, that is an AI version of him, singing along to popular tracks from bands like Coldplay, and also to some songs by good bands. I think we should be careful. What's great about music is the circle of life. Influential artists create a body of work, inspire the next generation, then pass the torch on. We're going to unpack some of these questions and help you figure out what's next.
This is Daybreak Europe. I'm Kriti Gupta. Let's get to the stories that set your agenda.
Taking you from the U.S. market's close.
A lot of this was priced into the U.S. session.
To the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
They don't have a case on capital rules. They can loan way more than they threaten that these capital rules will mean they can't loan to small businesses and to homeowners. They're not doing it enough anyway, and they're immensely profitable, stock buybacks, huge dividends, huge profits. at the expense too often of working families.
It is happening right now. Big bank CEOs on Capitol Hill for a hearing designed to hold them accountable. But it might be the lawmakers who get grilled, as Wall Street bosses are expected to make their case for watering down proposals they argue will harm the economy. JP Morgan's Jamie Dimon, Morgan Stanley's James Gorman, David Solomon at Goldman Sachs all arguing in prepared remarks that plans to increase capital requirements will push riskier lending further outside regulator purview. Your team coverage begins right now with Bloomberg's Sonali Basak and Katie Lyons in Washington. Katie, let's begin with you. What is the push from lawmakers today?
Well, there very much is a partisan divide, John. We were just hearing that evident in the opening statements of the chairman of this committee, the chair of the Banking Committee, of course, Democratic Senator Sherrod Brown of Ohio, who's talked about the importance of strict capital requirements. He calls the 8 CEOs testifying today 8 of the most powerful people in the country, given the sheer size of their banks and their ability to influence the economy. And he thinks stricter capital requirements are very important. He pushed back on the notion that it's going to mean they don't lend as much to first-time home buyers or small businesses, for example. On the other hand, you have the ranking member, Tim Scott, who is taking very much the other tune. Republicans on this committee, John, very much are opposed to the Basel III endgame by and large. They do not want to see these strict capital requirements imposed to the same degree on these banks. So you're going to start to see a little bit more of that divide. That divide might also be evident in some other topics likely to come up at this hearing. Senator J.D. Vance, the Republican, also from Ohio, has pushed back on what he says the politicization of big banks when it comes to issues like ESG and climate. But those very issues are things that Democrats may be taking the other side on. So it's likely to be on display in this hearing, John. But by and large, of course, the lawmakers in the room, while they do have the power to pass legislation, aren't ultimately the regulators who are actually going to be enforcing these different requirements.
Sonali, who gets the grilling today, the CEOs or the lawmakers?
A little bit of both. The capital rules are really the one thing. I talked to a group of bank executives just before this appearance, and I talked to them about whether they were nervous. And they said they actually feel excited this time around because they feel like they get the chance to make their case. Not that the lawmakers can change the rules around Basel III endgame, but they could force the Fed to slow down and take its time before implementing these rules and implementing them so drastically. Now, will they win out at the end? Interestingly enough, yes, this is largely considered a Democratic cause, but this does fall across party lines. If you think about it, we just saw Tom Tillis, North Carolina Republican senator, walk in saying that he felt that the game is rigged when it comes to the stress tests, that the banks talk to the bank examiners and they know what they're going to have to meet in terms of requirements and meet those rules. And then Sherrod Brown, in an interview just a couple of minutes ago, really had spoken to this idea that they don't have a case on capital rules here, particularly when they're minting record profits. So certainly there's everything from this big issue on how the banks move forward with these capital rules, but then there's everything else, like the topics of the day that they will likely be facing over hours of grilling in the Senate.
Sonali, there's 2 big issues that jump out to me. 1, they're going to basically say their ability to finance the economy is compromised, and 2, they're going to highlight the risks of transferring risk to private markets. Sonali, how strong is that argument going to be?
Listen, as somebody who's covered banking for more than 10 years, it's a bit of a frustrating argument because almost nothing has been done to regulate the non-bank system up till this point, and the banks have still been profitable. David Solomon, in his testimony himself, makes a point that the firms inside this room account for 2/3 of the lending and capital markets activity in the United States. And so it's not that the private credit market, only a $1.5 trillion market, has grown meaningfully but is much smaller. And so this idea that banking has moved so much out of the banking system is hard to buy by the numbers they presented from the hearings themselves. However, Jamie Dimon says it's not a threat, it's a matter of economics. And David Solomon says that it's everything from food companies to manufacturers to energy companies that will feel the sting if the banks are held back. And so it's a question of whether the lawmakers feel convinced or threatened at the end of the day by these testimonies.
Kaylee, you get the final word. These hearings, particularly at the Senate Banking Committee, is this about making good politics or good policy?
A lot of this is political, as hearings often are, John, because this isn't just a chance for those testifying, being the bank CEOs, to make their case. It is also an opportunity for the senators in the room to do a bit of a performance, get fodder for campaign announcements, perhaps. Just to kind of speak to the notion of how political this can get, if you look at the fact sheet that the Banking Committee sent out last night on the eve of this hearing, it highlighted specifically the compensation of these executives and the CEO pay ratio to the rest of the employees. It also had a number of articles linked to different scandals that these different banks have faced within the last year in more recent history. So a lot of this is indeed political in nature. How it informs policy going forward, John, we know that it's very slow work. They began looking back in March in the aftermath of the failures of SVB about what exactly needed to change, and yet we haven't seen that much material legislatively coming out of this committee or Congress more widely.
Katie, great coverage as always. Looking forward to your coverage a little bit later on Balance of Power with the team. Shanali Basak on the ground in Washington, D.C. for this hearing. So this is how this will take place. Introductory remarks, opening statements. What we're interested in, the Q&A, question and answer session. When that begins, we'll bring that coverage to you right here on Bloomberg TV. For the broader price action, the session looks better, up by 0.4% on the S&P. We're doing okay on the NASDAQ, up by 0.5. Let's get you some sector price action. Here's Abby.
Today's gain, John, it is broad from a composition standpoint, sector-wise. If we go into the Bloomberg and use the IMAP function, which is a great function to see what is happening for all the 11 major sectors, you can see that 9 of the 11 are higher, led by industrials, up about 0.9%, and then a sprinkling of most of the sectors, the ones that are not higher, energy and consumer staples. Now, banks not so long ago, they are still up about 0.6%. They had been in the second spot. Where we really have some strength, the regional banks, John, over the last 6 days, up 5 of those days, up nearly 10%. And an interesting headline just crossed from Huntington saying that the commercial real estate losses are not like 2008. So it seems as though investors are trying to get back into these regional banks after hoping, I guess hope is not a great strategy, but that the regional bank issues of earlier this year, that they're somewhat in the rearview mirror.
Lower yields helping those banks. Amazing to see. Just not what people predicted at the start of the year. High yields really hurting those banks. Abby, thank you. Coming up on the program, we'll get you another peek of the calendar for the rest of this week. A sneak peek of the trading diary coming up next.
That's me, Max. What's up? How are you? I have been writing about Wall Street for almost 15 years. And what that means is I write about feuds and rage and rises and falls and comebacks. And every now and then, I also write about a couple of villains. Thank you so much. And now, I am about to do something new and very, very scary. We are making a show, and it's based on Bloomberg Businessweek magazine. So what is this show about? It's a show about money, power, culture, pop business. We're gonna ask complicated and profound people about their ideas, their careers, their lives, their risks, their failures, their imagination.
It's so incredibly liberating not to care what other people think.
I was giving my tools to other communities. I wanted to bring those tools home.
Tune in. Like, please, like, really actually tune in. I desperately need an audience.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
It is the least anticipated annual get-together of the big banks on Wall Street getting together down on Capitol Hill. Least anticipated for them, I'm sure. The Senate Banking Committee hearing underway in Washington, D.C. The Q&A just around the corner. We'll take that Q&A right here on Bloomberg TV. The price action doing okay, up 1/3 on the S&P. Let's get straight to the trading diary. We're shaping up as follows. A Bank of Canada rate decision, top of the hour. The 4th GOP presidential debate kicking off in Alabama, 8 p.m. Eastern time. Thursday, another round of jobless claims. And on Friday, it's the main event. It's the payrolls report just around the corner, a few days away. From New York City, that does it for me. Thank you very much for choosing Bloomberg TV, and good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.
last 40 years about leadership in politics?
Well, I've been learning a lot about leadership for a very long time, observing it in others, recognizing what is needed to get the job done. And I always define it in this way: know your why. You have to know why you're doing this, because you will be under attack, this for sure. Know your why, know what you're talking about, know how to get it done, think in a strategic way, and then that's all up here. And then also connect directly with people. If you can show them how important what you're advocating is and what you know you're talking about, so they trust your judgment, and you have a plan, you will have followers. You will be a leader.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
This is Bloomberg Markets with Paul Sweeney and Matt Miller.
Why were the economists so wrong? What are the economists getting wrong?
Isn't this a slam dunk time to buy U.S. Treasuries?
Soft landing, hard landing, no landing. I don't know.
True. What the heck does that mean?
I don't know.
Breaking market news and insight from Bloomberg experts.
We're going to be in an environment with higher rates for longer.
The 5-day in-office work week is effectively dead.
It's definitely a good sign that we're not ready to land this economy just yet.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
All right, good Wednesday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. It is December 6th. What a day December 6th is. All right, we got Simone Foxman sitting in for Matt Miller, who is on paternity leave. We're going to have Simone Foxman for the next couple of days?
No, just today, but I'll be back. Don't worry.
Okay, very good.
Don't
very
worry.
good. That's all we got. Coming up, we've got the big bank CEOs are down in D.C. Testifying in front of the Senate Banking Committee. They're giving their testimony right now. When it gets to Q&A, the juicy part, we'll bring that to you. We're also going to kind of preview what we might see here from those CEOs. We got some smart people going to join us here. Sri Natarajan, he covers all of Wall Street. He's going to join us, as well as Nathan Dean. He's a senior U.S. policy analyst with Bloomberg Intelligence. He's the guy down in D.C. He knows what Congress is looking for about all this stuff. So we'll bring that to you, and then we'll bring you that Q&A from Washington, D.C. But right now, let's bring you John Tucker with the Bloomberg Business Week.
All right, Paul and Simone, as we look at the S&P 500 higher right now, you have 9 of the 11 major industry groups. They are in the green right now, being led by industrials, financials, consumer discretionary, but the biggest drag coming from some of the defensive sectors, consumer staples, to name one. Just a few days ahead of the jobs report, another economic report this morning showed more cooling in the labor market that the Fed wants to see. This is the ADP report. Private payrolls increasing 103,000 last month. That is way behind estimates, so we're considering that Fed-friendly. The two-year yield, in fact, up 2 basis points. Didn't expect that, but it is higher right now at 4.59. The 10-year, the benchmark, 1 basis point lower. That's at 4.15. The S&P 500 up 13 points. That's a rise of 0.3%. We're at 45.80. The Dow up 113 points. The Nasdaq 126 points higher. That's up 0.2%. And Ian Shepherdson of Pantheon Macroeconomics says, you know what, the Fed should be declaring victory over inflation, but they won't.
I think they're going to hang on, gripping with their fingertips until they can't hold on any longer to the idea that, yeah, we still have optionality to raise rates. Because, let's face it, that whole transitory thing was a disaster for them. And they've really engaged in this sort of reputation rebuilding exercise to prove to markets that they can get it right this time.
And then we also had surprising data from the Mortgage Bankers Association. Mortgage rates falling to the lowest in almost 4 months last week. We're talking 7.17%, and that is spurring demand for refinancing.
Oh, please.
Wow.
You're waiting to go down to 2.
No, I would love to get your rate, which is
3 1/4.
Oh, you killer.
3 1/4, which means,
that's
yes,
great.
my mortgage is less than the tolls that I pay every month.
That's
to
incredible.
Come in and out of Bloomberg LP.
I will say my brother, who lives in California, has under 3%.
Nice. That's how you do it.
And I was jealous. I refinanced at 3.65.
Oh, that's good. That's
ages
good.
ago.
That's good. All right, I'm sitting at 6, but don't worry. We're going to get back down to below 5.
All right. Well, with my blessing.
There you go. John Tucker, thank you so much. We appreciate it. Simone Foxman, Paul Sweeney, we're live here in our Bloomberg Interactive Broker studio. We're streaming live on YouTube as well. So head over to youtube.com and search Bloomberg Radio. As John was just reporting, we've got some gains here, early trading in the equity markets. Let's see where the action is under the hood. We can do that with Nora Melinda. She covers all those markets for Bloomberg News. She joins us here in our Bloomberg Interactive Broker studio. Nora, what do you got?
So back on that real estate beat, we're looking at Toll Brothers this morning. The home building sector is actually rallying to its highest intraday level on record. After Toll Brothers, which is a luxury home builder, reported earnings yesterday that beat on almost every metric. It did report better than expected 2024 deliveries forecast, but its orders did come in a little bit below consensus, likely due to the interest rate spike over 8% in October. But unlike other home builders, Toll Brothers didn't rely solely on offering incentives, and that's reflected in its gross margin of nearly 28%. As I said, home builders are now rallying in sympathy. The next home builder to report will be Lennar next Thursday, December 14th, and that company actually markets its homes as everything included, so it focuses on single-family housing and targets a number of demographics. But for that luxury market, Toll Brothers is really showing some positivity as we're heading into 2024.
You know the number here that I was really stunned by, 72% year-on-year increase in orders. I mean, just shows you how far we've come, despite the fact that, mortgage rates are much higher than they were
Insane.
But there's no existing home sales because people don't want to sell because of many reasons, including the mortgage rates. So the only way to meet the demand, I guess, is just to
keep building, and the market is really theirs. I mean, the sector has really been rallying all year, to your point, as you said, because there is no competition, and there is still increased demand for housing. So home builders are really shining through this year. Obviously, next week, we have the Fed meeting, that'll kind of bring some more things into perspective as to whether or not that rally will continue. But as we said, we had data coming out this morning saying that U.S. mortgage rates have fallen to the lowest level in almost 4 months. Don't know if that's really everybody refinancing, but it does show a bit of positivity there.
Yeah. You're looking at food names as well, right?
Yes, looking at Brown-Forman. That's our whiskey maker.
Sure.
It's falling.
No idea what you're talking about.
Right. I don't know. But it's tumbling on worse than feared second quarter results. It's sinking as much as 11% today, the most intraday since March 2020, after the alcohol beverage company reported an earnings per share and net sales for the second quarter that trailed estimates. It also cut its organic net sales and operating income forecast for the full year.
I thought this was the time of year that people are supposed to be drinking with family members.
You would think. And the company did say that it's optimistic about its prospects for growth of sales and income in 2024, but it said that it can't discount the idea of evolving global macroeconomic conditions.
Interesting. All right, McDonald's. Stock's up 8% year to date. I think they're having an investor day.
Yeah,
today.
I mean...
So we'll get some news coming out of McDonald's, presumably.
Right. The company said that it's looking to hit 50,000 locations around the world by 2027.
Wow. I mean, it just seems like there's McDonald's everywhere. Although
ambitious.
I always thought they were the biggest fast food chain, but it's not. It's Subway, I think.
Really?
Yes. That's a fun fact I learned recently.
There have been investigations too about Subway not necessarily positioning their franchises in the proper place, maybe having too many of them. I mean, and, that is, I guess, a private company has been acquired or was about to be acquired recently.
I have no idea. Subway, type it in and see what happens.
But McDonald's, where's that growth coming from? Is it mainly China? I know that was a big focus for them, right?
I mean, it's really a part of its multi-year growth plan. It includes a renewed focus on marketing. It's hoping to have some more core menu offerings like hamburgers and digital channels, including delivery, mobile app, and kiosks. But this is meant to be its biggest expansion in history, according to the company.
I mean, so where isn't there a McDonald's?
That's what I'm saying.
I mean, again, it just seems like they're everywhere. And I guess it's emerging markets, I guess you can go there. But there's some parts of the world that aren't real big on beef, so I don't know. Also, another name in the news, Exxon, boosting its buyback 14% as they continue to hunt for more oil. So there's a company that just, it's all about, for these energy companies, maintaining discipline. That's what the analysts tell us. Don't drill so much. Return capital to shareholders, dividends, buybacks, that kind of thing. So that's like boosting their buyback 14%. So that's a good thing for our good friends at Exxon.
But I guess, we're looking at WTI at 60 right now, $70, 60 cents a barrel. Maybe it's not a bad time.
Yeah, interesting. All right, very good. Anything else, Nora? Are we good to go?
That's about all.
We good to go. All right, Nora, Melinda, thanks so much for joining us. Give us a sense of what's happening with these markets. Again, the S&P 500 up 0.3%. Same for the NASDAQ, same for the Dow. Just looking at some of the video coming out of D.C., it looks like the CEOs are giving their prepared remarks. I'm looking at Jane Fraser, the CEO of Citi, giving her prepared remarks. Jamie Dimon's just concluded with his. So they're going to go right down the line. I think there's 5 or 6 of these CEOs there, and they're giving their prepared remarks. And when they get to the Q&A, that's when we'll bring you some of the live there. Sri Natarajan joins us. He covers all the things on Wall Street, focusing on the big investment banks here. And I guess, Sri, is there an agenda here, either on the part of Congress or on the part of these Wall Street CEOs?
Well, you only had to hear what Jamie Dimon had to say to figure out what is their mood as they are all gathered together in D.C. today. Jamie Dimon's comments, clearly a shot at the regulators, said, there is a climate in Washington where you propose first and study later. Not just Jamie Dimon, everyone else there with him in Washington today, all those CEOs are making the point that regulators are putting in place onerous new requirements that just don't make sense. Regulations were needed in the aftermath of the financial crisis in 2008. They saw the capital cushion that they needed to have in place go up significantly. Needed, it worked. They have stood the test of time, at least they stood the test of the last 15 years, and seem to be in good shape. New regulations are only going to hurt the banks and will push more business and activity and transactions into the non-banking sectors, which isn't all that well regulated. And to be clear, that is the opinion they are espousing in Washington today and have been doing for much of the last year, not our opinion. The Fed obviously disagrees with them. They recognize that what they're proposing will impact their business in terms of excess profits, but they're not really convinced that it'll have that sort of a debilitating impact on the economy that the bank CEOs say that it will.
Well, let's get some insight on the political appetite for this. And for that, we bring in Nathan Dean to join the conversation. He's our senior U.S. policy analyst with Bloomberg Intelligence, and he's in Washington. And Nathan, thanks so much for joining us. What kind of appetite is there among politicians to maybe minimize some of the burden that could fall on the biggest banks?
Yeah, so, the first part of this hearing, at least the goal of the big banks, is to put that pressure on the Fed, especially when you hear Jamie Dimon say things like cost-benefit analysis. What they're insinuating here is the Fed is actually conducting an APA violation, which then would potentially allow them to sue after the rule is put out. But the second part of this hearing, and to your question, is really to try and convince those moderate Democrats, Senator Tester and Senator Warner, to join their side on the burdens that this is placing. You have the increase in capital requirements That's one burden. But there are three pillars to this rule: market risk, operational risk, and credit risk. And the operational risk provisions, according to the banks, could have some harm on mortgage lending and so forth like that. So to try and convince those moderate Democrats to come to their side to put pressure on the Fed, because the Fed is an extremely thin ice, my words, in terms of its timing. Any delay that the Fed has, they're going to risk not getting the rule out before the 2024 elections. And if that happens and the Republicans take the White House, this rule may never even come out. So there's a lot of things at stake here.
Nathan, where is Congress broadly defined here? Is there bipartisan support to put more regulations on the big banks?
No. So, we saw the statement from the ranking member, Tim Scott from South Carolina today, that obviously there's extreme concerns. The debate really is amongst the Democratic Party. Is the progressives of the world is Sherrod Brown. Please remember he's running for re-election this year. So we saw an angrier Brown than we usually see this morning, or, than usual. But it's really the Senator Testers and the Senator Warners, those business-friendly Democrats, because this proposal came out and there is a whole host of changes that are going to have to occur. I think everybody's on board with that. The problem, though, is how many changes can you make without triggering that APA violation?
What is APA again? Remind me.
So this is the Administrative Procedures Act. This is the law that regulators have to follow to actually conduct a rulemaking. And when you say that somebody hasn't done a cost-benefit analysis, and in this case, the Basel III Endgame cost-benefit analysis was only 9 pages, you have lawyers down in Washington that are already drooling over the idea that after this is finalized, we're going to sue you because today's makeup of the Supreme Court makes it there is a decent chance. We even saw in the opening testimony today from Jamie Dimon that they're even hinting at this at a couple of other Fed and CFPB proposals out there. So certainly a lot of pressure is being put on the Fed to just get it right.
Shri, Nathan was talking through some of the pillars of this, and one that stood out to me from our reporting on this and your reporting on this was the idea that the regulators would have a standardized model for calculating credit and operational risk rather than letting the banks do it themselves. Can you speak more about some of the pushback on this? Because doesn't that sound maybe fair, I guess, from a public perspective on the outset? Where's the pushback internally at the banks, though?
It does, but I think the model has been that the banks had a little bit of leeway in sort of calculating their exposures and the capital that you need to set aside against it. And some of their arguments is just a different variation of what they've presented out there for years and years and years, which is some of the things that we do are just too complex for all of you to understand. That argument didn't really hold them in great stead in 2008, but they're hoping in 2023 it's a very different climate, and the point they're making will at least find sympathetic ears.
Hey, Nathan, do we know where the Biden administration is on this whole concept of additional regulations on the U.S. financial services industry?
Yeah, they're supportive of the Fed, the OCC, and the FDIC with their proposal. And, that's why we're continuing to tell our clients that we ascertain a 60% chance that this does get finalized in September, because this is the goal. And if you run the risk of it not being done, then let's just say President Trump wins the White House, you'll have an indefinite delay here. So this is certainly the White House definitely wants to get done, and I think they would hopefully try and get it done without legal challenges and so forth.
Shri, we have the big bank CEOs here testifying mainly, but couldn't most of the impact, the outsized impact, really fall on the smaller ones, the mid-sized, the regional banks? Do they have a better argument against some of these new rules?
No, actually, the way the new rules have been proposed, it's the banks which have at least 500 billion in assets and more that will feel the biggest impact, because especially the significantly important the SIFI banks, right, where their combined capital buffer on average I think goes up by about 19%. That is, if you look at the 6 big U.S. banks right now, they have about 145 billion in excess capital. If the proposed rules are enacted in their current shape, you'll actually have a bit of a $40 billion shortfall, which is why banks have already been talking about pushing back against the rules, but also preparing and trying to understand how they need to tweak their business, what risk-weighted assets to get rid of, and what other changes they need to make sure that they'll also be in compliance. Of course, this doesn't even get implemented for a few years from now. And as Nathan very correctly pointed out, you're also heading into an election year, and if there is a change of administration and you go from Democrats to Republicans, the future of rules like this are very much in doubt.
But post-collapse of Silicon Valley Bank, the money all flooded into the major banks. to some extent, I guess the argument you hear from the smaller folks is this so dramatically changes our costs. Whereas, on the other side, it changes the amount of capital you have to have, but it's not changing the overall processes as substantially, I would imagine. But correct me if I'm wrong there.
I think independent of new regulations, the business model for the mid-sized banks is challenged. A lot of what was their traditional business has been flooding into the non-bank space anyway.
All right, so Nathan, how far does Congress really want to take this here? I mean, what's the feeling in D.C.? Is it that the banks just make too much money, or is there real concern about the risk they may pose in a global economy? What's really the politics behind this?
So I don't think there's really a consensus. The reason being is that, if this was 10 years ago coming out of the financial crisis, there would have been a lot more thought about this. And when Fed Vice Chairman Michael Barr began talking about the Basel III endgame, he used words like banks need to be humble and there needs to be a touch of humility. I was talking to a couple of bankers the other day, and the gentleman said, look, I would have taken that 10 years ago. I'm not taking that in 2023, especially after we got through a pandemic. Now, but that being said, for all this talk of bank regulation, there is this concern out there of private credit. And if the Basel III endgame is going to drive lending from this banking segment into the private credit industry, where there is no regulation or very much little regulation, the policymakers are going to have to respond to that. The problem is that over at the Financial Stability Oversight Council, the FSOC, they're on 1 year of year one of year 7 of doing this. So they're still 5, 6, 7 years away from having actual tangible proposals in this area. So I don't think really anybody really knows what they want to do. They're just trying to figure it out as they go.
All right, Sri, how hard are they going to fight here? How you think the banks, if this goes through, are they going to go to courts, or are they just going to, all right, we'll take it?
I mean, as Nathan pointed out, they've already laid the groundwork for making the argument for why they would want to sue it. This right now, they're not even thinking about what they will have to do if the rules go ahead as proposed, because a lot of the CEOs have actually expressed optimism and hope that their initial back and forth, they sense that there is some willingness to water down the rules. They obviously would push and push and push to make sure it's completely watered down or undone altogether. But the fight goes on until what the rules look like in their final shape. And if it gets implemented or it gets finally in place, anything like it is currently being proposed, then that fight will continue on for much longer than that.
All right, Sri Natarajan, thanks so much for joining us. Sri Natarajan, Bloomberg News, covers the big investment banks for us, joining us live here in our Bloomberg Interactive Broker Studio. And via Zoom is Nathan Dean, Senior U.S. Policy Analyst with Bloomberg Intelligence. He's down in Washington, D.C. He is our go-to person for all things coming out of the Hill. Right now, let's get a little bit of a reset here on these markets, and we'll do that with John Tucker.
All right, Paul and Simone, the major stock averages, they are all higher. Payroll processor ADP saying American businesses added 103,000 jobs for the month of November. That's the year's second lowest reading. Leisure and hospitality, a driver post-pandemic employment cut back. So did factories. Well, this data is all considered to be Fed-friendly and supports the idea the Fed is done with rate hiking, and cuts could come as soon as the first quarter of next year, and that's pushing risk assets higher. S&P 500 up 15 points. That's a rise of 0.3% at 4582. The Dow Jones Industrial Average up 114 points. That's a rise of 0.3%. Nasdaq 100 44 points higher. That's up 0.3%. And the standout today, the small caps, Paul, the Russell 2000 right now, that is up 1.5%. And we check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash, Simone and Paul.
That's what they call, in the technical world, improved breadth of the market when you get some of the small caps. That's a good sign for the health of the market.
So the Magnificent Seven expanding
Broadening
out
a little bit.
to everybody else.
Small and mid caps. John Tucker, thank you so much. We appreciate that. We have Simone Foxman, Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio. We are going to bring you soon some Q&A from Washington, D.C., the big CEOs of the big banks down as John has his breakfast, the CEOs of the big banks down in Washington, D.C.
I'm like trying to do this. It's like operating in a movie theater. I'm trying to have my snack without disrupting anybody.
Food flying,
got Mr. Solomon
food flying in New York, sparks flying in D.C.
We
shall
Mr.
see.
Solomon from Goldman Sachs. We see him testifying right now. When we get to the Q&A, we'll bring that to you. I want to kind of get a little bit of a preview here, what we might see. Michael McKee covers all our economics for Bloomberg, joins us here in studio. And Shonali Basak covers Wall Street for Bloomberg. She is down in D.C. covering this event. And Shonali, I want to start with you. Boy, it's a who's who of Wall Street down in Washington, D.C. What do you think these CEOs want to get done today? What's on their agenda, do you think?
You know what's amazing is that when I walked into the room to talk to some of the executives of the big banks before their CEOs started to testify, I said, listen, Brian Moynihan looked kind of nervous walking down the hall. And they said, actually, you know, everyone's kind of excited about today. And the waiting room was buzzing and loud. And it's because this time around, the bank CEOs see this as a way to get their voice heard. This idea that these rules are unwarranted, these new capital rules, these ideas that doing so will constrict their ability to lend to food companies and manufacturing companies and energy companies. And so they're sitting out making a case very significantly. You know, you even had in the prepared remarks for Jamie Dimon that this is not a threat, it's an economic reality. And so I would be surprised, even in the question and answer question part of the testimonies, I would be surprised if they didn't try to redirect every answer to the capital rules once again.
Mike, how much of an economic reality is this, actually? Do we have some estimates?
No, we don't. But I think Sherrod Brown put it very well in his opening statement that this is somewhat theater. The banks want to make as much profit as possible, and there's nothing wrong with that. That's their job as bank CEOs, and it costs them money to have these fees and capital charges tacked on. So they're going to try to convince the lawmakers that an issue that lawmakers have no stake in is important, because it's the regulators who are doing this. I kind of refer to these hearings as thank you, sir, may I have another? If you remember in Animal House when Kevin Bacon got battled. They come down once a year and they get beat up by members of Congress. And then, you know, Shonali and I were talking earlier, then they go out and they will go visit the regulators and they will lobby and they will make their cases, and that's going to be the better use of their corporate jets than sitting in front of this panel.
Hey, Shonali, you know, one of the big areas that is of interest to a lot of people is this private credit, the growth of the private credit market. And a lot of the bank CEOs are referencing it that, hey, because of the rules, a lot of our lending activities we're backing away from an economic perspective, and that's going to this private, unregulated private credit business. Do you think Washington has appreciation for what's happening there?
I'll be very explicit about that question in a minute, but I also want to point out the interesting thing here, it's the places that these lawmakers are most worried about, it's not places that private credit touches to begin with. They're most worried about rural communities, low-income neighborhoods, places where bank branches are shrinking daily and annually at a rapid clip. They're worried about jobs. They're worried about minimum wages. And these are places that, you know, private credit, a $1.5 trillion business, where, you know, compare that to JP Morgan with a GDP about the size of France, you know, in terms of the asset base size, it's close to the GDP of France. You know, the size of the private credit industry is much smaller than the banking system today. And even in David Solomon's own testimony, he says that the companies in that room represent 2/3 of all lending and capital markets activity in the United States. And so the banks have already been stepping back. That is true. Since 2008, absolutely, private credit has gotten bigger, and the banks have gotten out of certain critical activities, particularly the mortgage businesses have shrunk. But also, if you think about the outcome of these hearings, what has happened? You know, bounce check fees, for example, have dropped by $2 billion in America since these hearings have started. The CFPB has created more actions against inappropriate overdraft and hidden fees. That's now a Biden administration kind of initiative, if you will. You've also seen a lot of changes. Some of these banks have raised their minimum wage by $5 or more. You have to remember that these are not just multi-million-dollar investment bankers. Many of these companies are housing a lot of tellers and places where jobs are very concerned to be replaced. Job seekers are very concerned about being replaced by AI.
But, Shonali, if the concern from lawmakers is going to focus on lack of banking services for rural communities, what's the response from these CEOs to why they don't have more of a presence there?
So on one hand, and this is also a very direct reflection since these hearings started, that they have made commitments to boost their lending to low-income neighborhoods. In part, the government has to incentivize this stuff. Tax-efficient investments in low-income neighborhoods, for example, is one way they kind of meet in the middle here. But, they've made larger commitments, but relative to the size of their asset base, these commitments are fairly small. And so, every year, this is kind of the time they take stock again and said, how much are you really giving to our communities? Interestingly, in both the testimonies of Jane Fraser and of Jamie Dimon, they both point out Ohio as a test case. Guess where Sherrod Brown is from? Ohio. And so there's no, there's no accident really there. It is a big community, and they very much have reasons to be asking these bankers about, what they're charging their constituents and the prices people pay for their banking services, particularly after many of these banks have taken a bailout.
Right now, looking at James Gorman, the CEO of Morgan Stanley. He is testifying, and when we're done with all the CEO prepared remarks, the Q&A will open up, and we'll bring that to you live. That tends to be where we get some real back and forth here. Michael McKee, when I think about just kind of lending to some of these communities, it's not the J.P. Morgans or the Bank of Americas per se, but it's more the 4,000 regional and small and community banks. I mean, what's the economic stress on them? I mean, they are the ones that are really lending to small town Main Street America.
When you talk to regulators, they're not finding these banks particularly stressed. There are some that maybe have the seeds of the problems that SVB and others did when their hold-to-maturity portfolios and their available for sale portfolios don't match up in maturity, and you could have a problem if there were a run on the bank. But in general, that's not seen as a major issue, and they are making loans. The interesting thing that comes up regularly in the small business surveys is that access to credit is not a problem for small businesses. And they're the ones who are most affected by all these rural area banking questions. And so at this point, it's kind of a solution in search of a problem.
That's
to talk about that. I mean, there are a lot of other issues with the bank CEOs and the big banks, but access to credit for Americans is not a huge one.
I think you're going to see a lot.
But one of the things that we've reported on extensively, there have been plenty of big takes and otherwise, is that individuals have trouble accessing credit in some of these areas. They can't get a mortgage, and that doesn't necessarily seem like a priority.
Well, it's a question. There's two questions. One is how much of an effort do banks make in distressed areas? And there are regulations about that. There's a whole revamp of the regulations for the Community Reinvestment Act that is coming into force that should address more of that. It is an issue. The other is the economic aspect of it. Nobody can get a mortgage right now because mortgage rates are so high. And when you have an economic situation like we have now, of course, banks raise credit standards. So you have to separate those two things. And I don't think either one is a major issue at this point for the committee, other than perhaps just to blow off steam at the bankers, because, as I say, there are regulations coming into effect on that score.
Hey, Shonali, how united do you think these CEOs are down in D.C.? Because if I'm Morgan Stanley or Goldman Sachs, I'm not really in the lending business that much like Bank of America or J.P. Morgan, so I really don't care that much. How united are they, do you think?
They are quite united. In fact, both of those banks, I did talk to representatives of them, and I asked them, how much are you guys talking about the way you guys fight against capital rules? Part of the reason I invited the CEO of the Financial Services Forum on air with us yesterday, because that's kind of the main forum in which these discussions happen. And you do have, some differences. You have JP Morgan really highlighting every dollar that they commit to these neighborhoods in their testimonies and their annual reports. And Goldman, in their testimony, really highlights at the very beginning they have very, little to no exposure when you think about the relative size of their asset base and their exposure to, say, small businesses. For example, they have a program called Goldman Sachs 10,000 Small Businesses, but that's 10,000 small businesses, right? I mean, they do what they can, but this is not their primary business. So yeah, there are differences among the banks. However, when you think about the big banking system, most Americans, if you Google J.P. Morgan and Morgan Stanley,
right,
you will get, people will wonder the difference. People ask the difference all the time.
All right, Shanali, we're going to jump. The Q&A has begun. Shanali Basak, thank you so much. Bloomberg News reporting from Washington, D.C. Michael McKee here in our Bloomberg studio as well. Right now, let's go down to Washington, D.C. The Q&A. Senator Sherrod Brown from the state of Ohio.
Proposed capital standards are not too onerous. Mr. Scharf, American support for unions, as we've discussed, is at a half-century high. Unions help ensure that workers share in a company's success through better pay and better benefits, control over their schedules, greater stability to their personal and professional lives. Workers at 2 Wells Fargo branches will be voting to unionize this month. Dozens of other union organizing drives are in the works. Wells Fargo's recent scandals highlight the pressure that overworked and underpaid workers at short-staffed branches face. One worker said the executives don't have to deal with the consequences of their decisions in a direct sense, but we do. Mr. Scharf, I appreciate your willingness to talk one-on-one about this with me. I remain concerned about unfair labor practices and reports that Wells Fargo is geared up in response to the union campaign. Will you remain neutral as these employees vote to organize?
Chairman Brown, I agree with your sentiment about the importance of the workers and our employees. And we've, as you know, we've done a tremendous amount to support them and we'll continue to do that. And we believe that it's best that we have a direct relationship with those employees, and we do intend to exercise our right to speak with them to make sure that they make an informed decision.
Thank you. It was an opportunity to show the American public truly a new day at Wells Fargo. I'm sorry that you failed to show that real change is afoot at your bank. Mr. Scharf, Mr. Moynihan, Mr. Diamond, and Ms. Fraser, according to the CFPB, failure to invoke the Service Members Civil Relief Act interest rate reductions cost service members $100 million between 2007 and 2018. You can unilaterally act to ensure service members receive those benefits, the escrow benefits they're entitled to. Do your banks proactively check authorized military databases to identify accounts that may be eligible for escrow protections? Begin, Mr. Scharf.
Chairman, we have huge respect for those that have been in the military. Specifically, to your question, I'm not sure, but certainly we'll check and get back to you.
Okay, thank you. Mr. Moynihan.
We again follow the SCRA provisions on an annual basis. We retroactively, looking back after we get notification, about $180 million a year we send back to those service members, including fees, which are not required to rebate, but we go ahead and rebate them. So I will check to make sure we're looking at all available means, but we comply with the law.
Thank you, Mr. Diamond.
I'm sure we comply with the law, but it's an opportunity to say that we hired 18,000 veterans in the last couple of years. We support the United States military. We've hired 3,000 military spouses. So we stand 100% behind the class of citizens we hold in the highest regard.
Thank you. Ms. Fraser.
Similarly, with Chair Brown, we are very proud to employ many veterans, and we're incredibly grateful for everything that they do for our country. We make extensive investments in ensuring that we comply with the laws, and we do indeed tap into the database.
Thank you. Thank you for your candor about that. I urge you all to proactively check whether customers are eligible for escrow benefits. It's the type of work that you could be doing. The answers were helpful, and we will be back with all 4 of you about how we can help do that proactively. There's plenty we don't agree on. It's pretty clear. But I also want to finish somewhere we do agree. Supplemental security income. SSI provides a lifeline for 300,000 Ohioans, nearly 8 million Americans living with disabilities. The problem is SSI's eligibility rules haven't been updated by Congress. That's on us. In 40 years, they're now so outdated, they lock people in poverty. The Bipartisan Policy Center called SSI's asset limit the most regressive anti-savings provision in federal law. I have a bipartisan bill with Senator Rounds of this committee to raise the program's asset limit and stop punishing people for working and saving. Mr. Diamond, I know JP Morgan Chase is supportive of raising the asset level. I thank you for your leadership on this. Tell us briefly how it affects JP Morgan and why you're so supportive. Then I'd like to ask all of you if you would join Mr. Diamond and Senator Rounds and me in support. Mr. Diamond.
Senator, thank you. We have employees who don't want us to increase their salary because if it goes over a certain amount, they can't get that benefit, which they're entitled to. Or they can't have assets over $10,000. So this definitely should be fixed. We fully support it and try to be helpful if we can.
Thank you. Mr. Scharf, would you agree to support Mr. Diamond's position and mine?
It sounds like something that we'd be willing to support, but I'd like to take a look at it.
Okay. Mr. Moynihan? Ms. Fraser?
Fully and wholeheartedly.
Okay. Mr. Hanley?
We do support it.
Thank you, Mr. Vance.
We do support it.
Mr. Solomon?
We do support it.
Mr. Gorman?
Yes.
Thank you all. Senator Scott.
Thank you, Mr. Chairman. Question for the panel. The chairman asked a question about can you achieve the increased capital requirements? My question is, can you achieve the increased capital requirements without negative consequences to the economy and to lending?
Senator, we do have concerns that some of the items in the proposal will lead us to either increase the price or to reduce the amount that we lend.
There's a chart in the NPR that looks deceivingly simple. It says, here's the RWA before the proposal, and here's the RWA after proposal. It says 24% increase. That is a reduction in capacity of this industry to serve its clients. No questions asked. The capital could have been used to create those additional RWA. Incremental has to be used to sustain the same activities we have today with no risk from the day before to the day after and what the enterprise does. That's the point we're trying to make, is that this is about using our capital, whether we have it or not, and whether we have it to meet the new requirements to support additional activity, not the old activity, which doesn't help the American economy.
Thank you.
I think one of the frustrations you hear from this group up here is this question should have asked before it went out. There's no question. We have to hold 30% more capital than international banks in the United States of America for every loan. A lot of loans have now have become unprofitable. So a lot of loans, when we talk to Bill, they don't make sense for our company anymore. Small business, CDFI, solar, wind, middle market loans, certain trades you do with pension plans, et cetera. The work should have been done beforehand. By law, the QIS was the qualitative impact study should have been done beforehand. We had 10 years to do this, and it's shocking to me that we're sitting up there 10 years and we're talking about what's it going to do for small business, and we have to analyze it today. It should now. We all are going to fill hundreds of pages, thousands of pages of forms responding in a very detailed way to every single one of these things, but it was not thoughtfully done. I'm not sure it was shared fully among all the regulators. This should be relooked at.
And before I go to Ms. Fraser, my assumption is everyone's going to say, with consequences, that will be negative. So let me ask a different question to you, Ms. Fraser. The impact, and perhaps the unintended impact from Basel, the end game, on customers. We so often talk about the American consumer as if there's just one generic consumer out there. But from a state like South Carolina, where we have a lot of farmers, the impact on farmers and access to not only credit, but liquidity during the hard times. Can you perhaps give me a 30-second reaction to, will this have a negative impact on some of the rural communities that need derivatives? Will you walk me through that for a second?
Certainly, and thank you very much for your question, Senator. This will, to your point, increase the cost of borrowing for farmers and rural communities. It could impact them in terms of their mortgages. It could impact their credit card. It could also, importantly, impact their cost of any borrowing that they do. And let me give you an example. For a farmer, hedging your commodity costs and your commodity prices is an absolutely fundamental piece of providing stability and ability to sleep at night. Under the Basel III proposal, the cost of the derivatives would increase quite materially, and that would therefore have an impact on farmers' ability to do a fairly fundamental component of risk management. It could also impact their access to credit. So it's the cost of borrowing, it's the access to credit, and it's some of the fundamental tools that they need to manage their stability of their income.
Mr. Solomon, you said something earlier that I thought was really important, that as we discussed the Basel Endgame proposal and its impact on lending and on folks like me that come from poverty or looking for the ability to achieve the American dream, someone would say, contrary to what I'm talking about, maybe there are other points that are important that I'm missing in my thought process, like, is it going to make our financial system safer? Have we not done enough work since the financial crisis of 2007 to 2009 to make sure that our financial institutions are able to meet obligations and responsibilities under an even worse case scenario? And your opening comments reflected that, yes, we can meet even a more disastrous crisis. Can you walk through the importance of the regulatory burden that exists and how the Basel Endgame would make it even harder for small business lenders or small business borrowers, but not necessarily making our economy safer?
Sure. Thank you for the question, Senator. I tried to highlight in my opening comments, and Mr. Gorman highlighted it quite clearly. These stress tests are very, very significant tests that look at very, very severe shocks to our balance sheets. I highlighted a 50% decline in equity prices over a one-year period, on top of then a simultaneous equity market shock that has looked at much as 30% instantaneous equity decline. So very, very severe shocks that we've not seen even in the worst crisis. That puts buffers in place that protect the system. Now, of course, a sound and secure system is imperative for our capital markets, and we can always have debates at the margin as to whether or not there are things that we can do that can strengthen the system. But a wholesale increase of 25% capital in the largest banks with lots of individual provisions that affect different activities, I think is ultimately punitive to economic growth and doesn't strike the right cost-benefit analysis. We, of course, need to make the system secure. The system is in good shape. We've seen that under stress. That doesn't mean there aren't things that can be done at the margin, but this is a wholesale change that leads to problems. Ms. Fraser highlighted one example talking about farmers. You can look at airlines hedging jet fuel. If you want to look at other derivatives, which obviously gets passed on to consumers, you can look at gas being hedged in utilities, which obviously gets passed on to consumers. And then you can look at other transactions. There's a provision under the rule called SFT, which allows institutions like ours to borrow securities from pension plans and give them cash. That increases the returns. It allows them to use their assets to increase the returns. Capital would increase by 8 times for those types of transactions, which would make them unattractive and therefore would diminish the ability for pensions to access that tool to increase the returns. Thank you. Thank you, sir. Scott, Senator Reid from Rhode Island is recognized.
Thank you very much, Mr. Chairman. First, let me all thank you for your support of our military men and women. They are superb, and their spouses are superb, so thank you for helping them out. With respect to the legislation that we passed several years ago, the Military Lending Act, I think the key aspect is the 36% interest cap. And I think it's such a critical aspect that it should not be just a province of military personnel, but every American. I think essentially your banks collectively have made about $219 billion in profit this year, and I believe that your credit cards are not beyond 30%. So the 6% rather, interest rate seems to be very appropriate. And so I can go down starting with Mr. Scharf. Would you support a national 36% interest cap?
Senator, I appreciate your thoughts on this one. I think we would be concerned about setting a flat number without really understanding what the impact could be in different inflationary environments.
Mr. Moynihan?
Senator, it's not really relevant to us. We don't engage in prime lending. I think, as Mr. Scharf said, it's a question of balance. What would it push outside the system? What would it make not available? And I think, but it's just not a relevant question for us because we don't have rates that high.
Well, I guess in a general sense it's relevant because most of the people who use this adversely are payday lenders and rather dubious operators who will induce borrowers into arrangements which are something you wouldn't even tolerate. So I think that we've reached a point now after several years of questioning you all, and I'm not picking on you, Mr. Moynihan, to come to a conclusion. And I think the conclusion is it should. Mr. Diamond, please.
Yeah, we don't engage in that. I completely agree with your intent. I think there should be a focus on payday lenders and check cashers and certain things like that. And we'd love to help you design it so it accomplishes the intent without any bad consequences. There are some people who make very small loans who it may stop them from doing that and actually push people into payday lending.
Ms. Fraser, please.
Senator, thank you for the question. We applaud the intent of what you're trying to do. I think as large banks, we're very mindful of our responsibilities in protecting our customers from abuses. Experience has shown that caps diminish access to credit, can do in the systems, and the Federal Reserve has a study to show that. So I think similar to my colleagues, we believe there are other ways to achieve the intent, but we'd be supportive of following up with you on how.
Mr. O'Hanley.
Senator, we don't engage in consumer lending, but we do support what you're trying to achieve there.
Thank you, sir. Mr. Vince.
Senator, we're also not in the consumer business, but we support the intent.
Thank you. Mr. Sullivan.
We have a very, very small business in the consumer area, but we support the intent.
Thank you.
I support it, Senator. For normal, what I consider normal economic times, I actually came to this country and borrowed at 24%. So not quite your 36. I found that particularly heinous, but it turned out okay. But no, I think anybody who's forced to borrow at 36%, that's sort of unforgivable.
I was living in the United States when I was borrowing at 24%. And in fact, I recall we had to repeal the Rhode Island legislation because it was 21%. So, again, I hope to work with you on this because I think it's very important. And I don't think it'll cause the disruptions which you might anticipate. I think it can be done. And I think the other thing it should be done, and I know many of you are doing it, is to go out aggressively and start getting people banked. One of the reasons that they find themselves borrowing money from unscrupulous characters is because they have not been fully introduced to the banking system, understand that it's relatively easy and it's much more appropriate than some of these other arrangements. But thank you all, and we'll continue to work, and any advice I'd appreciate.
You're listening to some of the largest CEOs of banks in this country, Jamie Dimon, James Gorman, David Solomon, Jane Fraser, and more testify in front of the Senate Banking Committee. They're in the Q&A session. Let's listen back in for more.
Sometimes that means that we get to have you folks participate in that disagreement process. Today, you're going to hear us talk a lot about consumers as they are the latest victim of heavy-handed Washington bureaucrats. In the last few months alone, financial regulators have put forth or finalized regulations and guidance that represent the biggest rewrite of banking regulation since the passage of Dodd-Frank. We've seen regulations on bank capital, long-term debt, resolution planning, the Community Reinvestment Act, and climate risk management, just to name a few. However, we know that none of these regulations exist in a vacuum. Vice Chair Barr said himself that the Basel III endgame proposal is, and I quote, projected to raise capital for large banks. This may result in higher funding costs. But this is only half the story. End of quote. I want you to help tell the other half of the story. Now, I was just going to ask this of one of you, but since our chairman has kind of set the example of asking folks to raise their hands, and I'm going to apologize in advance because I think folks hate to be put in that position, I think it's critical that you get to tell the other half of that story. None of you raised your hands when you said that it would be, that it was a case of where you couldn't meet the capital requirements. The issue is what damage it does to the economy when you're expected to raise that and the folks who need that capital. So here's my questions, and I'm going to ask you to raise your hands. I apologize for that, But if you agree with these assessments, would you please raise your hands? Do you believe in its current form, could these regulations negatively impact first-time home buyers? Do you believe in its current form, could these regulations negatively impact those saving for retirement? Do you believe that these regulations could negatively impact our farmers and our ranchers? And do you believe that these regulations could negatively impact small business owners? See, this is the rest of the story. Sometimes we think that we're just beating up on the big banks, but the bottom line is it hits the American consumer where it hurts. This is at a time that when they try to go after the big guys, it's the American consumer that will suffer. You can already see the signs of consumers struggling as they are utilizing the buy now, pay later approach to products and making late payments on credit cards. This is because Americans are paying more per month just to get by since President Biden took office. Bidenomics has led to a family of 4 in South Dakota needing to pay over $900 more in month just to get by for normal living expenses. I'm going to say this again, regulation does not exist in a vacuum, and the Federal Reserve must take this into account as they work towards finalizing their rulemaking. I won't embarrass you by asking you to raise your hands anymore. I apologize for that, but I think it's important that the American people see the rest of the story and who is really going to pay the bill for this overzealous approach, and without finding out the rest of the story about these types of regulations and who really gets stuck with it. In recent years, U.S. federal debt levels have climbed further, and annual interest on the debt is slated to reach over $1.4 trillion in the next decade, almost outnumbering all discretionary spending. I'm concerned about what risk rising indebtedness poses to the economy. According to recent estimates by your institutions, the Treasury will conservatively need to issue $20 trillion of debt in the coming decade. I'm not only concerned about who is going to buy this massive issuance of treasuries, but with a federal funds rate of 5%, the federal government is going to be paying even more to borrow as treasuries with near zero rates mature. Mr. Solomon, how could sustained high levels of debt have adverse effects on the U.S. Treasuries market, the dollar, and the general economy?
Thank you for the question, Senator. This is a significant issue and one I tried to highlight in my opening remarks. The growth in the U.S. Treasury debt has been very, very significant over the last 15 years. It's more than tripled. That debt will continue to grow as the cost of refinancing that debt will also grow. The Office of Budget and Management, looking out through the decade, estimates a 3.5% cost to refinance the debt, but I certainly think there are scenarios where that cost could be higher. This cost obviously hampers our ability to invest in other things, as a nation that we need. There certainly is a lot of attention and focus on things that are needed to strengthen our economy, to strengthen our society, and the cost and that burden of the debt to future generations based on decisions we've made is something that we're going to have to get focused on. As the cost of debt goes up, it certainly can create volatility in our funding treasuries. It can create volatility in the treasury market. One of the things I'm also concerned about when I look at Basel III Endgame is one of the impacts is to a business called Prime. The business of Prime finances institutions' securities positions. So asset managers, investment managers, asset management platforms that regularly trade in the treasury market provide liquidity to the treasury market. And the cost of the financing that they have to finance those positions would go up with this proposal, and it could potentially, therefore, impact liquidity. And so that's another risk that I think we need to look at carefully.
Thank you, Mr. Solomon.
Thank you.
Thank you, Mr. Chairman. Senator Tester is recognized from Montana.
Yeah, I want to thank the chairman, ranking member, for holding this hearing. I want to thank the panelists for your testimony and for being here today. And I also want to echo Senator Reed's comments on your support for the military, both active duty and veterans. Them and their families is very, very important. I serve as the chair of the Defense Appropriations Committee. I spend a fair amount of my time thinking about national security, how to protect against folks who want to do this nation harm, terrorist organizations, as well as foreign adversaries. you all have responsibilities, including legal responsibilities, to make sure that you're preventing hostile governments like Iran that would like to see the U.S. not exist from financing terrorist operations and other illegal activities with funds that have gone through your institutions. So this would be a question for Mr. Gorman, and then not for any particular reason, it's just he's right in front of me. And then if any of you would like to add, you can. So the question is, how are you as chief executives making sure that procedures are in place and that they're followed so that your institutions do not end up inadvertently financing illicit activity?
Senator, thank you for the question. Obviously, it's critical as a good player in this country to do our best to work with the government. There are two things that I just point out. The first is what I call our cybersecurity efforts to understand incoming into the financial system. Several years ago when I started this job, I believe we were spending about $50 million on that activity. The number is closer to $1 billion now. We work very closely with all the intelligence agencies, ensuring that we have a proper cyber command to keep the financial system safe. And then secondly, as it relates to specific individuals, bad actors, governments, we have an enormous compliance effort focused on anti-money laundering to ensure that they don't get in by verifying the source of where their funds come from. Obviously, we deal with not as many clients as some of the institutions here, but we still have over 18 million individual clients and many, many tens of thousands of institutional clients. So it's an extraordinary effort with several hundred employees constantly working. Interestingly, I think the advances in AI will be a real strategic weapon in this regard.
Very good. Anybody have anything different to add? All right, thank you. Along those same lines on anti-money laundering protections and national security safeguards, Mr. Gorman talked about cybersecurity. Mr. Solomon, would you like to add anything in regards to anti-money laundering protections that you have?
I don't have anything to add that's materially different from what Mr. Gorman stated. An enormous focus. We file thousands of SARs in the course of our compliance department's financial crime team, working every day, but no difference in that focus and the intensity of that focus.
Very good. Earlier this year, Mr. Scharf, Wells paid nearly $100 million in penalties to the Fed and OFAC for violating sanctions against Iran, Syria, Sudan. I think we can all agree that's not a good thing. But what is your bank doing to make sure that these sanction violations never happen again?
Sure, Senator. Preventing bad actors from abusing our services is a top priority. We have extensive systems in place that we're constantly looking to make sure that they're as complete as they possibly be. We work in industry groups, we work with the government, and we work with the regulators to make sure that we're doing everything we possibly can to prevent that abuse.
Thank you. This goes to the non-banking world. Some of you have talked about the fact that, and maybe all of you have talked about the fact that this will force, Basel will force money to go outside the traditional banking system into the unregulated banking system. Ms. Fraser, could you just talk about what kind of impact that you see that having from a, I don't know if you can project percentage of money that you would see going into the non-banking system, but it would be interesting because I remember in 2008 that was the problem, one of the problems.
Yes, Senator, we are worried about the migration of financial activities into the non-banking sector, particularly in a period where there is tremendous technological innovation, and making sure that we maintain the safeguards that we all invest billions of dollars in a year, be it anti-money laundering, be it fraud protection, be it cyber protection. All of these areas protect the American consumer, protect the American saver, safeguard the system, and also the critical role that all of our banks play in the global financial system as a strategic asset of the U.S. So we are very concerned that this will undermine some of the strength and foundations of the unique American financial system.
Thank you all. Thank you, Mr. Chairman.
Thank you, Senator Tester. Senator Tillis of North Carolina.
Thank you, Mr. Chairman. Thank you all for being here and for the preparation. I'm actually very pleased. I thought it was going to be the annual flogging of the GSIBs, but people were asking very serious questions. I'm glad to hear it. I've got a few serious questions for you all. Number one, I want to start by saying that thank goodness you're not the head of an organization that's had an expose on a culture of sexual harassment and workplace hostility, because I guess if you were, every person up here would be asking for your resignation, including me. But we've got a top financial regulator that gets a pass. I don't expect you to respond to that, but it's true. That same financial regulator has implemented an SEC cyber reporting rule that now we have evidence that the ransomware companies are exploiting, right? Okay, this is a mandatory cyber reporting requirement that now a ransomware company has gone on record as reporting. I don't even want y'all to respond to that, but we've got, detailed questions, we're gonna ask you what impact this is. A 4-day reporting requirement, a national security waiver that you have to reapply for every 30 days, and it has to be approved by the Attorney General. These people are out of control. We've got to try and repeal this one. I'm actually putting forth my first CRA to try and do that next week. Hopefully, the SEC can see that the bad guys are exploiting a rule, creating a burden for our financial services industry and not producing a good result. That's all on that. I want to go back to the operational risk question. And I think that Senator Rounds did a good job of saying this Basel III endgame is bad. It's not very well thought out, and hopefully it's going to look very differently before it gets promulgated. But who would like to speak for this group around the impact on operational risk just one more time and how we think that they've missed it in terms of the benefit? Mr. Gorman, if you could do it in 30 seconds, I would appreciate it.
It makes no sense. I mean, that's the bottom line. I've been at this for a long time. I served on the New York Fed board for years. I've seen a lot of rules. Some of them make sense, and it's a question of how far you turn the dial. This doesn't make sense. You shouldn't punish institutions for creating fee-based businesses.
Is there any evidence that that work has been done to really understand the fully burdened cost and the impact of this rule on the industry? And more importantly, people like my dad who would get 90-day notes to fund his construction job that I used to work on? Is there anything out there that I've missed in terms of the regulators actually doing an exhaustive study of the impact and the downstream implications? Are you aware of anything that I have just simply not read?
I'm not aware.
Okay, thank you. Mr. Solomon, would you go back to the I think you mentioned SFT, security financial transactions. Can you go back and talk a little bit about why people in the pension business should be worried about the promulgation of this rule in about 30 seconds?
Sure. Securities financing transactions are transactions where institutions like ours borrow stock securities from pensions. We pay them cash. They can then invest that cash and earn returns. The capital in Basel III attributed to those transactions goes up by 8 times, would make the transactions uneconomical for businesses like us, so we would exit that business. That would then prevent the pensions from having that ability to increase their returns through that activity.
So anybody who is sitting on top of any sort of pension management should understand that if we implement it in its current form, their returns, at least in this segment, are likely to go down.
They are an end user that would be impacted.
Yeah. Okay. Let's talk more about just I want to talk, I actually have to get something off my chest because I've heard more, I'm kind of doing that, y'all may have noticed, but I understand that you are gaming CCAR, that somehow that you can game stress testing. That's what I'm hearing from regulators. I'm hearing from my colleagues on the other side of the aisle. Give me an idea of how you game the system. I actually thought that this is a regimen that's provided by a supervisor or an examiner, and you've got to execute it, and then they have to measure it. Is that how it works? Any of you here want to share with me how you game the system? I used to work at Price Waterhouse. We didn't have a practice on gaming CCAR stress testing at the time. Have y'all cracked that code? How many of y'all think it's absurd to think that people would actually assert that you could game a stress test? Okay. How many of you think that you're spending more time and money on trying to satisfy stress test requirements at the expense of looking at real risks that are unique to your banking activities?
I'll take this one.
Okay, Jamie.
The CCAR test is 200,000 pages long. Most of us do 10, 20, 30, 40, 50 tests a week. We're quite worried about risk. It's one test. It's to the nth degree It's a big black box. So we all agree in stress testing, that thing's just out of control.
Yeah, and you know, in closing, look, Silicon Valley was a disaster. It was a fingerprint. It was unique in terms of their activities. It was a failure of supervision, in my opinion. And one thing I hope that we have over the next year is a hearing on everybody who was in the loop, who failed to protect the investors and the depositors at Silicon Valley. Thank you, Mr. Chair.
Thank you, Senator Schultz. Senator Menendez of New Jersey is recognized.
Thank you, Mr. Chairman. For over a decade, the CFPB has stood up for everyday Americans and fought back against abusive and unlawful practices by large businesses, including some of the banks in this room. Mr. Diamond, how much money has J.P. Morgan Chase returned to customers in the form of redresses and payments at the direction of CFPB?
I don't know the number.
Let me help you. $360 million. Mr. Moynihan, same question.
I don't know the number specifically.
$819 million. Ms. Fraser?
I don't know the number either, Senator.
$1 billion. Mr. Scharf?
I don't know the number, Senator.
Well, it's over $2 billion. So from just the four of you, that's over $4 billion. It's amazing you don't know the number because they're not small in nature. Over $4 billion returned to hardworking consumers in the past dozen years. And yet this critical agency is under constant attack by my Republican colleagues. A lawsuit before the Supreme Court is threatening its very existence. And time again, we've seen why the CFPB is so necessary and why I intend to continue to fight for it. Otherwise, that would have been $4 billion out of the pockets of U.S. consumers. Now, while some banks have either decreased or eliminated overdraft fees altogether, in large part due to increased scrutiny and oversight, banks still collected an estimated $7.7 billion in 2022 in overdraft and non-sufficient fund fees. Ms. Fraser, your bank eliminated overdraft fees last year, isn't that correct?
Yes, Senator.
Is it fair to say that Citi is still a profitable bank?
Yes, Senator.
Did overdraft fees upend your business model?
No, Senator, we work hard to protect our customers and make sure that they don't fall into overdraft.
Now, the rest of the banks here that have retail operations continue, to my knowledge, to charge overdraft fees. Mr. Moynihan, Mr. Scharf, Mr. Diamond, you're all aware that Black and Hispanic households disproportionately incur overdraft and NSF fees, correct? Do you know that? Yes or no? Could you give me a verbal answer, please?
I believe so.
If that's your statistic, I don't have any reason to challenge it.
Same for me.
Well, the reality is that, again, it's amazing you don't know that. The study after study have shown that the answer is yes to that question. So I suggest you call Ms. Fraser after this hearing to figure out how you can still be able to eliminate the fees in its entirety and still run a profitable bank. Charging the fees is a choice, one that disproportionately harms Black and brown communities, and it's something that you could do that would change the course of events for a significant part of the consumer base. The lawsuit currently before the Supreme Court over the CFPB's funding structure has the potential to upend every rule, guidance, and order the CFPB has ever issued, tossing over a decade of consumer protection law out of the window. That's not just harmful for consumers, I think it's dangerous to the financial system. The CFPB doesn't just issue regulations, they also provide safe harbor provisions like the qualified mortgage rule, which protects mortgage lenders from certain lawsuits. Mr. Scharf, Mr. Moynihan, Mr. Diamond, Ms. Fraser, if you were to lose this safe harbor, would it impact your bank's mortgage lending?
I don't think it would make a difference. We did mortgage lending before this, we do it afterwards.
I think it completely depends on the actual detail in the ruling.
Same, I'd like to know the specifics to draw a conclusion.
Same as my colleagues, I'd need to understand the specifics more.
Well, I'm saying if it would just if you would lose it, not if it's limited or what. If you would lose it totally, it seems to me pretty remarkable based on previous testimony of how important the safe harbor provisions would be to banks' mortgage lending abilities, that you would suggest that it would have no effect whatsoever. We're already in the midst of an affordable housing crisis, and eliminating the CFPB and such a rule would have a disastrous impact on the mortgage market and make it harder for families to buy a home. Finally, the number of physical bank branches in the U.S. have been trending downward for some time. This has left more and more residents in so-called banking deserts, facing difficulties in carrying out basic financial tasks such as paying bills and depositing checks. A Philadelphia Reserve report found that bank closures during the pandemic resulted in the number of banking deserts in the 3rd District states of New Jersey, Pennsylvania, and Delaware rising from 48 to 63. Now, I understand part of this is mobile and online banking, but there are many who do not have the abilities to do that. What are some ways that we can ensure communities continue to have access to basic banking services?
Two things, Senator. I think if you look at the people who have big branch systems, we maintain approximately 30% of our branches. Mr. Scharf said earlier, we're same for us in LMI neighborhoods. But importantly, one of the things that's gone on, and you mentioned, is we're up to 97% of our LMI customers use digital banking, which then is more convenient, more safe, and reaches them where they are. And so we manage that carefully to make sure we cover every market and make the calculations. You can see that in the published statistics. But if you look at what we do as a group of institutions, we maintain that presence, but we've driven the digital, and we've driven the types of accounts that are more appreciated. And that's why we're bringing 2 million people into the banking system that were unbanked a few years ago. It's largely these larger banks that have driven that.
Well, I'd close by simply saying I would commend to all of you that you look at how your practices affect particularly minority communities, including on this issue. You have a disproportionate effect, and there's something you can do about the largest growing parts of the American society that would be beneficial to you and beneficial to them. Thank you, Mr. Chairman.
Thanks, Senator Menendez. Senator Kennedy of Louisiana is recognized. That's really good.
Unlike some, I do not think you are crooks. In fact, you're all American companies, and I'm proud of you. And I thank you for supporting the most sophisticated and powerful economy in all of human history, and the jobs you create for Americans in doing it. Mr. Diamond, since the last time the federal government raised your bank's capital requirements in Dodd-Frank and otherwise, have you had a depositor run on your bank?
We have not.
Have you failed a stress test?
We have never failed a stress test, no.
Have you ever reached a point where your liabilities were greater than your assets?
Absolutely not.
Well, unfortunately, we've had 3 banks this year that did go broke. Mm-hmm. They're mid-sized banks. You know them: Signature, Silicon Valley, First Republic. We've held hearings. In my judgment, they went broke because their management did really stupid stuff. And because the FDIC and the regulators who were in charge of keeping them from doing stupid stuff sat there like bumps on a log, sucking on their teeth, and watched them do stupid stuff. And in many cases, had to turn to you to clean up the mess. Now, in fairness to the FDIC, it may have been that the people in charge of watching those banks at the FDIC were too busy urinating off the top of a hotel or abusing young women who went to work for the FDIC. The FDIC chairman told us recently, yes, he knew about it, it happened, but he wasn't the chairman yet and didn't have the authority to stop it. Mr. Diamond, don't you find it ironic? The FDIC is now turning to you and saying, you know our track record, which is blemished at the FDIC. Your bank isn't broken, but we're going to tell you how to fix it. Do you find that ironic? They're going to tell you how to fix it based on standards put together by bureaucrats in Basel, Switzerland, not by the United States Congress. Do you find it ironic that they're telling you this and proposing this? Isn't that kind of like being given gun safety advice by Alec Baldwin?
Should I answer the question? So the major risk of those banks was hiding in plain sight, which is interest rate exposure. That was known to most people who actually could read a balance sheet and read their financial statements, and that's true. I also think
the FDIC said they didn't know. They were busy doing whatever else they were doing at the at their Gomorrah of carnal abuse over there.
Yeah. I also do think you're making a good point that some of these rules were put in place, and some folks have mentioned here, are pushing business outside of the banking system. And to point out exactly what that is, it's almost 80% of the mortgage business today. It's half of the leveraged lending business today. And it's a bunch of other things which people don't actually see about the plumbing of the system. And I do think it's adding risk about transparency. And a very important thing about the impact.
Let me stop you, Mr. Diamond, because I'm going to run out of time. How is this even legal under West Virginia v. EPA? You have bank regulators without clear direction from Congress who are borrowing standards from other regulators in Basel, Switzerland, imposing them on you without clear directive from Congress. It clearly falls under the major questions doctrine. Why doesn't this violate West Virginia versus EPA? You don't have to know a law book from an LL Bean catalog to see that. Why doesn't it violate the law? Anybody?
Senator Kennedy's time has expired. Senator Warren from
Ms.
Virginia.
Fraser was about to answer.
Would you like to answer, Ms. Fraser? I thought you gave her time. Proceed, please.
I think we very much appreciate your points of view, Senator, on this topic, and I think many of us would concur. While violations of law, we hope, are things that we will debate as a last resort. We would be prepared to do so because it's important that there's clarity in the law and that we abide by it.
Thank you,
Senator Warner.
Thank you, Mr. Chairman. I do find it's kind of an interesting presentation, the yin and yang of whether you're the source of all challenges or the regulators are the source of all challenges. Somehow I don't believe either presentation represents the truth. And my questions on Basel III have been raised already. I've indicated I think the timing at this moment is very problematic with interest rates as high as they are, and obviously members of the civil rights community have raised this as well. But before anybody smiles too much, I can also tell you that I get extraordinarily frustrated that any time there is any proposed new regulation or rule, the normal industry reaction is, oh my God, the sky is falling. And the same response is always, you do this, it's going to limit access to capital on Main Street. And I actually do think Senator Menendez's presentation, particularly on CFPB in terms of dollars returned, was pretty good. But I want to actually go to an issue that I've raised with many of you in the past, which is I do believe before we add new regulatory tools about the safety and soundness of our system, one of the things we actually ought to use better is some of our existing tools. Very beginning, when the Fed was stood up, the most important liquidity tool was the discount window and use of that tool. And yet we saw with the banks that failed this year, particularly in terms of SVB and Signature, they didn't even have procedures in place to know how to utilize that tool. So I think I'll start with Mr. Moynihan on this one, but I know there was guidance given out this past July to say everybody ought to get their act together. And candidly, I don't have a lot of sympathy because of the concern that many of you and other colleagues have raised that, oh my gosh, if I go to the discount window, that's going to raise a stigma with the market. Well, you can't complain about new regulations if you aren't using existing tools. So beyond the guidance that was given, why shouldn't we have, maybe on some kind of random basis, a mandatory use of the discount window so that we could start erasing that stigma to make sure that every bank, from large to small, know how to use it? Because at least in terms of liquidity, this would be the most powerful tool of all. Mr. Moynihan.
So, Senator, I think two things. One, readiness to use it, and I think you'd find that the institutions all here, because of the amount of regulation we have, are ready to use it, and that was an issue of readiness that you rose. But then the second question is the stigma, and we couldn't agree more. Whether it was in 7 and 8, whether it was in 2020, or whether it was last spring, every time a crisis hits, one of the core roles of the reason why the Federal Reserve exists is to provide that liquidity at a time of stress in lender last resort. And every time we're 100% reluctant to use it as an industry because it looks like we're weak, and we've got to figure out a way to change it.
Again, and that's again where I think you see folks on my side of the house complain that, you know, if you're not using existing tools, well, maybe you ought to look at new tools. And I would love to engage with you. I'm going to put legislation forward that would require some mandatory usage, and maybe again how we do that on an episodic basis. But just saying we know there's a stigma problem, but we don't have a plan to address it, means that somebody that might be sometimes sympathetic to you, if we can't use that tool, my sympathy is going to go down dramatically.
We agree with you, Senator.
Let me try to hit a couple of other times. Artificial intelligence, I know, has been touched. I personally am surprised that there is not greater concern about AI in terms of using its ability to disrupt faith in the public markets. To me, it feels like if there was ever a time and a tool that has such wide-reaching implications, that FSOC, which I know his record has been somewhat mixed, but I strongly believe FSOC ought to take on the responsibility around looking at artificial intelligence in terms of safety and soundness to the overall system. Ms. Fraser, we've talked about this a little bit. What do you think on that issue?
Thank you, Senator. You're raising a very important issue and topic that has all
All right,
of our
we're listening
attention at the moment.
to the CEOs of some of the largest banks, financial institutions, speaking in front of the Banking Committee of the Senate and the Q&A there. So lots of back and forth between Congress and the CEOs. Right now, let's go to John Tucker and get a Bloomberg Business Flash. John.
All right, before we get to the numbers, some breaking news crossing the Bloomberg terminal. Paul and Simone. Kevin McCarthy, Congressman, the former Speaker of the House, leaving Congress is the report. And, of course, we will have full analysis coming up right here on Bloomberg Radio with our own Joe Matthew. Again, Kevin McCarthy announcing that he is leaving Congress. Right now, the S&P 500 to reset for you. The market's up 4 points, a rise of 0.1% at 4570. The Dow Jones Industrial Average 43 points higher. That's up 0.1% right now. And the Nasdaq 100 just 5 points higher at 15,882. And the data from this morning, American businesses adding 103,000 jobs in November, the year's second lowest reading. This according to the private payroll services company ADP, and it comes ahead of Friday's all-important jobs report from the Labor Department. As we look at Treasuries right now, the 2-year up 2 basis points, that's at 460. The 10-year 3 basis points lower, and that is at 413. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Simone and Paul.
Thanks, John. So some big news crossing just as John was beginning to speak. Kevin McCarthy, the former speaker, leaving the House. In a Wall Street Journal editorial, he writes that no matter the odds or personal cost, we did the right thing. That may seem out of fashion in Washington these days, but delivering results for the American people is still celebrated across the country. It is in this spirit that I have decided to depart the House at the end of this year to serve America in new ways. He goes on to say that he will continue recruiting his best and brightest to run for elected office. To break this all down for us, we're joined by Balance of Power anchor Joe Matthew. Joe, where is this coming from? Is this a surprise?
You know, I'd say yes and no. There was actually quite a bit of speculation. The fact that we had not heard from McCarthy about his plans was generating a lot of questions about this. There was actually an LA Times article posted about a week ago that talked about a tip that he was going to do this very thing. Remembering, of course, that Kevin McCarthy was fired from his job as Speaker, the job he always wanted his whole life a couple of months ago. And there were questions about what is he going to do now? I mean, does he stand in line in the cafeteria with Nancy Pelosi and talk about the good old days, or does he go do something else to maybe go make some money? And he says in his op-ed, I know my work is only getting started. So a lot of us are wondering what it is he has planned for the future.
Hey, Joe, any thoughts, early thoughts on what this might mean for the leadership within the Republican Party?
Well, it doesn't mean a heck of a lot. I mean, he's already been shown the door. And I think that's clearly what, led to his calculation here. The question that I have, Paul, is the same thing going to happen to Mike Johnson? Are we going to be having a conversation about Mike Johnson a couple of months from now about how he's leaving because he got fired as Speaker? Because we've got a lot of very difficult things to figure out, and it looks like Johnson is going to need Democratic votes to do anything from here, including funding the government and avoiding a shutdown in January. That is the very thing that got Kevin McCarthy fired. So the question is, will the rank and file put up with this, or are we going to go through it all over again?
Joe, I mean, McCarthy had some backers within the Republican Party. That's how he was able to become Speaker in the first place. Did everyone sort of walk away after he was fired as Speaker? Did they distance themselves from him? And how will this impact, their ability to move forward in this current situation under Mike Johnson?
Well, you asked a couple of different things there, and I do want to be clear. The majority of Republicans in the House actually seem to support Kevin McCarthy. The fact is the line was so tight, it's such a tight majority, that only a couple of troublemakers can make it impossible for a mainstream Republican like Kevin McCarthy, as he appears to be, relatively speaking, make it very difficult for him to have the job. Look, Kevin McCarthy has raised more money than just about any Republican in the country in this cycle. He is actually, he's teeming with relationships. And we have to just kind of take a more realistic view of what happened here. He was fired by a very small number of people, and the same thing could happen to the Speaker now.
And I guess it also begs the question, Joe, does this suggest that maybe the far right part of the Republican Party is even getting more powerful within the party in general?
Well, I suppose you could certainly make that argument, but I think it comes down to margins here. There's a 4-seat margin in the House. So one person like Matt Gaetz could have an enormous impact on the overall conference, and that's really come at the chagrin of dozens, if not well over 100 so-called mainstream Republicans. The mainstream Republican partnership is 90 members strong, the Problem Solvers Caucus. They don't want any part of this stuff. And even the so-called Freedom Caucus, the hard right group in the House, while they have some issues with Mike Johnson, they were not responsible as a group for firing Kevin McCarthy. So, it's really come down to tribalism. It's a splintered conference with a very tight majority, and it allows wild things to happen. It's like a low-volume day on Wall Street can generate extreme volatility. We have that version here in Washington.
How is Mike Johnson's speakership going at this point? Has he learned anything from the McCarthy era about...
Oh, clearly. I think that a lot of his moves have been based on what he just saw happen. But he's having some trouble. He hasn't really managed to get anything done here. We have a staggered shutdown coming. He did pass a continuing resolution to avoid a shutdown. That's one thing we can say. But he needed Democrats to do it. And so there's a lot of questions about what he might be able to accomplish here as we consider funding for Israel and Ukraine that will hinge on a deal on the border. That's going to take incredible leadership. It's something that's been elusive here in Washington for decades. And if we're going to do that in the next couple of weeks, he's going to have to obviously consolidate power in a very effective way. And the jury's just still out on that.
What's the typical next move for somebody of this position, Joe, when he or she leaves government? Is it to go back their law firm or go to Wall Street, or where do they typically go?
Probably. It depends. You write a book, you make speeches, you do that thing for a year, and then you get on a board somewhere, something like that. But I'll get back to the fundraising aspect. I think that Kevin McCarthy will have an enormous influence in this campaign cycle. He will be sought after by every Republican candidate who wants a piece of that money, and ironically wants his endorsement, even though he got fired here. He'll be able to impact races for better and worse. And let's remember, he has promised to avenge some of the actions that were taken against him in the House. I'll tell you what, I would not want to be Matt Gaetz in his effort to be reelected this year, because Kevin McCarthy will dump an enormous amount of money to support his opponent. You're going to see that happen in several instances around the country.
Do you see him trying to lead the RNC or any similar style position?
Oh, I think that would be considered a kind of a downgrade. If you were Speaker of the House, you don't run the RNC. And the RNC is in such disarray right now that I don't think Kevin McCarthy would want to go near it, to be honest. I think he'll probably have, he wants to be a statesman. He doesn't want to run the party.
In terms of, legislation that is pending, I mean, aid to Ukraine and Israel is front and center for a lot of people in Congress. Does this change the calculus there at all?
No, I don't think so. I mean, look, Kevin McCarthy was in the rank and file while he still was pulling some strings in the background. This really is Mike Johnson's problem. It's Mitch McConnell's problem. It's Hakeem Jeffries and Chuck Schumer, the guys who actually have the job, and they do not have an agreement to take care of any of this stuff. It's really interesting. If Ukraine funding came to the floor of the House, it would probably pass with bipartisan support. But Mike Johnson cannot afford to bring it to the floor because he'll get fired. His rank and file, they don't want that to happen. They want H.R. 2, the much more strict border bill that they passed at the beginning of this conference. And so he's really handcuffed in this case, and I'm not sure what breaks loose. It's likely the Senate will have a deal on the border. When they send that to the House, it's very unclear what happens, and they might spit it back. So we could be having this conversation in the new year in case something happens. Anything's possible, but it's not real likely in the next week.
All right, Joe, thanks so much for joining us. Really appreciate it. Joe Matthew, host of Sound On Bloomberg Radio and on Bloomberg Television as well. Again, Representative McCarthy leaving Congress at the end of the year. Right now, let's go back down to Washington, D.C. World and national news with Amy Morris.
Hey, Paul, it's actually Nancy Lyons.
Nancy Lyons, sorry about that.
That's okay. Former House Speaker Kevin McCarthy, as you've been talking about, has decided to leave the House at the end of the year. He says he's decided to serve America in new ways. He made the announcement in a Wall Street Journal op-ed. The California Republican served 17 years in the same congressional seat. His departure does leave the House GOP with an even slimmer majority until a special election can be held to fill his seat. Russian President Vladimir Putin is in Abu Dhabi, hoping to shore up partnerships in the Middle East. Putin's visit to the oil-rich region is his first since the February 2022 invasion of Ukraine. Senate Majority Leader Chuck Schumer plans to hold a test vote today on billions of dollars in aid to Ukraine, but Republican demands for tighter border security are complicating matters. Bloomberg Government's Jonathan Tamari has more from Washington.
Republicans want major border policy changes to be tied to this. They say that the border is also a national security issue, the same as Ukraine and Israel. Democrats say, listen, these are two separate issues. Do not tie immigration to foreign aid. These are two separate topics. If you want to have a debate about immigration, then there's got to be a back and forth on immigration policy.
Bloomberg Government's Jonathan Tamari. The White House has warned that support for Ukraine will run out before the end of the year, unless that $61 billion supplemental aid package passes. Global news 24 hours a day and whenever you want it with Bloomberg News Now.
All right, Nancy Lyons, thank you so much.
This
Nancy
is
Lyons,
Bloomberg.
thank you so much. We appreciate that. Billy House joins us, Bloomberg News down in Washington, D.C. Billy, big news coming out of your area, the woods down there. What's the initial feel from the folks down in D.C.?
Well, they were anticipating a potential departure by former Speaker Kevin McCarthy for several weeks now, but it's official with his documenting that in the Wall Street Journal, the column. He says he's leaving at the end of the year, and already nixed an already narrow House GOP majority, but it's the end of a kind of I guess, era, if you want to call McCarthy's tenure that.
One thing we haven't discussed is his district. I mean, is there any sense that a Democrat could step in there, or is this a firmly Republican part of California?
Well, it's been rated as firmly Republican, and it has not gone for a Democratic presidential candidate. It was solidly Trump, but it was also a sitting leader of the Republican Party running from that district as well. It's Bakersfield and the surrounding area. So it'll probably stay Republican, but of course it could be a lot more competitive than it has been for, 10 years?
Hey, Billy, I don't know, this is really speculative, but is there any sense what role McCarthy may now play in a presidential election in terms of support, who he would campaign for, where he would, and how valuable his support would be?
Yes, well, if Trump is the party nominee or the leader, that is even more uncertain because they've had a hot on-again, off-again relationship. But he does write today in his column that he intends to stay involved in running money and raising money for Republicans, and he's been very good at that, and would assume that would include the presidential race. So that's all we know at this point. He probably will remain active. How active he might be for Trump, who knows?
Yeah, that's what I was going to ask, actually. Has his ties to Trump, have they dimmed in any significant perspective? Would we see him potentially go raise money for a Nikki Haley or a DeSantis?
Well, that's a very good question. As we remember, there was a period in time when Kevin McCarthy was referred to as "my Kevin" by the former president, and then there was a falling out. Then there was a meeting at Mar-a-Lago where they got back together, and now McCarthy has expressed privately his disappointment in how Trump did not come essentially to his rescue in the Speaker ouster fiasco, or in his really a brief attempt to make a comeback. There was no Trump backing then. So there's certainly some bad feelings.
So, Billy, just give us an update. I mean, your beat is Congress. What are our friends in Congress actually doing? What's on their to-do list? What should we be watching for? I mean, I think my government's still funded, but what do they need to get done and when?
Right. Well, the government needs to be funded, but those questions are just around the corner at the beginning of the year when new shutdown deadlines come up. But right now they're focused on trying to get Ukraine aid or deciding whether to do that. And, of course, Republicans in the House say no, and Senate are saying, no, we aren't going to do any of that unless you add border security measures here in the U.S. There's also fights over surveillance renewals, legislation renewals, defense spending renewals. So in some ways, there's a lot going on, and in other ways, there's just absolutely nothing going on with all the limbo and standstills.
Are there any sense, or is there any sense among members at this point about which potential, where we could see compromises on this border security for Ukraine and Israel aid? You know, what are the factors in play that might shift to help get us to a deal?
Well, so right now, the hardliners in both chambers are essentially saying they want something like H.R. 2. Now, that's a bill that was passed in the House that is very rigid, beefing up border agents, asylum rules, that sort of thing. If there could be a pullback on some of that language, there's some Democrats who have suggested or signaled that they could go along with that. But there's still suspicion also of where is all the Ukraine money going, and many Republicans say it's not really being accounted for, and that's another whole issue. It's really hard to see an agreement coming together before they take off for Christmas.
All right, Billy, thanks so much. We appreciate that. Billy House, he's a congressional reporter from Bloomberg News, helping us break down this news that Representative McCarthy is going to leave the House at the end of the year. Let's bring on Nathan Dean here. He is a senior policy analyst for Bloomberg Intelligence. He's also based in Washington, D.C. Nathan, everybody, or the few folks we've talked to about this news here is saying it's not a surprise. Well, it's a surprise to everybody in the Bloomberg Interactive Broker Studio. Maybe we're just ensconced up here in New York and we don't know what's going on in D.C., but this seems like a surprise. What's the feeling that you're getting from a policy perspective about what this might mean?
Well, obviously, it's not fun to be the former speaker and have to, sit around for the next year and lose all that power and that influence. And so maybe this is the opportunistic time to bow out. From a policy perspective, former Speaker McCarthy really wasn't playing much in a lot of the bills that we're tracking. But I would just note that, with George Santos leaving and Kevin McCarthy leaving, that's only 3 votes that Speaker Johnson can afford to lose. And as we are getting close to this government funding fight in January, that's going to be something to take into account. So overall, I don't think it's much of a catalyst event, but at least from the investor point of view, but it's certainly something that we'll be paying attention in January as we get closer to that funding fight.
Now, Nathan, I know you've been paying attention all morning to the news of the day that we thought was going to be the news of the day. The Senate Banking Committee hearing testimony from some of the CEOs of the largest banks. Has there been anything surprising to you that's come up at this point?
So, this is a fun hearing to watch because 99 times out of 100, these hearings, the CEOs are on the defensive. That's not the case today. They are going on the offensive in regards to this proposal called the Basel III Endgame. Now, we haven't really seen much in the way of surprises from the policymaker perspective. I think some of the folks wanted Senator Tester to air some grievances about the proposal. He actually focused on national security and AML, so people didn't really get what they wanted there. But I think what this opportunistic, or at least what this hearing is a good opportunity for the big bank CEOs to get these grievances out in the air. It's like Festivus come early, and see if they can try and get some of the pressure on that Fed, because they're certainly airing it. The Republicans are certainly receptive to it, and with Elizabeth Warren about to come up in the next few minutes, it'll be really interesting to see what she has to say.
Any sense that these Wall Street CEOs can and their lobbying efforts can, in effect, watered down to some degree some of the proposed legislation, whether it's, in terms of capital requirements and so on?
Absolutely. The Fed is on the ropes here. The Fed is skating at, because they put this proposal out, and there is, I think, a lot of disagreement, both on the, you have the capital requirements increase, but then you also have this standardization model. So there's 3 pillars to the Basel III Endgame: the operational risk, credit risk, and market risk. And that operational risk, this is something that the banks have never had to have as binding before. And there's a lot of down layer impact here. So we've seen it from Senator Warner in his statement today. There's concerns about the impact of mortgage lending. Now, the Fed has a challenge. So they've put this proposal out, and everybody, I think, is agreement that there needs to be changes here. But can the Fed make all these changes and not have to re-propose the rule? Because if they do and they finalize it, there could be an Administrative Procedures Act violation here. So I think there's general agreement that there are amendments coming. Can they find that right amount of just making it right so that the moderate Democrats are happy, the progressive Democrats are happy, and eventually the courts won't rule against them? I'm not sure. So the Fed is really on a tricky path right now. We'll see probably in around February, March, after the comment deadline, where they're feeling.
One of the points that was raised during these hearings so far, the parts that we've listened to, has been that why are we doing this now? We're seeing high interest rates, and this is just going to eliminate some of the funding in the system, and therefore that's going to mean credit conditions are tighter. Is that something that's salient, you think, with that, I guess, key moderate Democrat contingent that needs to agree to this in order to see it really move forward?
So I think there's 2 thoughts here. One, this was something the regulators always wanted to do. Remember, this is something that Europe and the UK have already implemented. The Americans are just about 3 to 5 years behind. But also, let's remember that it took President Biden several years to get his people in place at the regulators. There was a woman who was a candidate for Michael Barr's position at the Fed. She withdrew, couldn't get the votes, and so that took time and that delayed things. But to the regulatory defense, we had a regional bank turmoil issue earlier this year. It's hard to focus on policy when you're doing that. So this proposal came out at the tail end of the administration. And so, I think it's just one of those unfortunate timings where the economy and the policy goals just didn't line up.
Nathan, we're speaking to Nathan Dean, Senior Policy Analyst for Bloomberg Intelligence in Washington, D.C. President Biden is scheduled to speak at noon today, Wall Street time, to discuss a number of key issues, including the war and funding in Ukraine. Nathan, and we will bring that to you when he does speak. Nathan, there's a lot of items on the agenda for Congress here, and they're getting ready to leave, I'm guessing, for the holidays at some point soon here. Should we expect anything of note to actually get to move to get some movement here in terms of legislation?
You know, it's looking less and less likely it's going to happen before the holidays. I mean, we have Ukraine aid, we have Israel aid, we have border security. FAA reauthorization does have to happen by the end of the year, so don't be surprised if they do a quick kick the can down the road bill on that. But it's looking like all of this is going to be roped up into this funding fight that we're seeing in January. I mean, you've got 4 out of the 12 appropriation bills going under, or at least going offline on January 19th. And if we haven't made a decision on Ukraine or Israel or border security at that point, and I don't think we will, because I think policymakers are ready to just go drink their eggnog and head home. I just think January is going to be this month where they come back and it's all going to come together. Now, I do believe that a deal can be made. I mean, there are enough folks that want Ukraine aid, that want Israel aid. Whether border security is in there or not, that's still to be determined. But, the problem that's happening right now is there's nothing putting pressure on policymakers that says you must do this right now. The government funding fight could potentially be that catalyst in January.
Yeah, we were talking to Billy House earlier, who's also in D.C., about what the potential facets of that deal might look like. Do you have any sense of exactly which pieces of the border security and which pieces of the Ukraine aid or the monitoring of it could, at least we could see some people compromise on both sides of the aisle?
Yeah, what we're looking for at BI is the Ukraine overall number. President Biden proposed in his around $43.6 billion for Ukraine specifically. And my colleague, Will Lee, who covers the defense contractors, put out a great piece talking about how that could be a single-digit revenue gain for those, large publicly traded defense contractors. So what we're looking for is, can the Ukraine aid go ahead, and what's the overall dollar amount? The Israel aid, the dollar amount is much smaller. It doesn't have as much of an impact on those defense contractors. So, as we think of like investment decisions in January, notwithstanding the whole government funding issue, that's our key priority.
So it's interesting. There's so many moving pieces down there, Nathan. I mean, I guess at the end of the day, something will get done.
But what?
But what? I mean, I don't. It's really hard to say where we're going to go on this, but there's so much that needs to be done in terms of funding, including some of the foreign aid. I'm not even sure who's in the driver's seat here.
So it's going to be Speaker Johnson, obviously from the Republican side, and it's going to be Senator Chuck Schumer in the White House. But just also remember this: we have an election next year. There is going to be a point where the policymakers are going to say, look, I don't want to deal with this anymore. I've got to run for re-election. Senator Sherrod Brown, even in the hearing today, was a much angrier Sherrod Brown that we had ever seen in recent hearings, I think, because of that re-election fight. So when it comes to the government funding and so forth, January and February, there's going to be a lot of negative headlines, a lot of we don't know what's going to happen. But ultimately, we do think something will come together, because nobody wants to be in these types of fights 3, 4, 5 months because before the election, for two reasons. One, you want to show that you can govern, but two, if you're here in Washington fighting, you're not out in your district campaigning, and if you're running against somebody who's not in Congress, that's a lot of airtime that person's going to have to spend in the district. So look for Congress to actually come together and get this stuff done, kick it off their plate, send it to 2025, and say, I'm just focusing on the election now.
Just quickly, in the last 30 seconds or so we have left, there seems to be some distance between Speaker Johnson and his counterparts in the Senate. I mean, how do we narrow that gap?
There's always going to be differences. I mean, the distance never comes closer. I mean, I can't remember a time where, other than kicking the can, where they just said, oh, yeah, you good? You good? No, it doesn't happen like that. But what does happen is the pressure. And Speaker Johnson has pressure. Senator, Chuck Schumer has pressure. And so as they get backed into these political walls, right, the question is, who is going to actually feel more of the pain? And that's when they come together.
Nathan, great stuff as always. Appreciate you hopping on there. Nathan Dean, he's a senior policy analyst, Bloomberg Intelligence. Lots going on in Washington, D.C. today. Former Speaker McCarthy saying he's going to leave Congress at the end of the year. And, of course, we still have the Wall Street CEOs speaking in front of the Senate Banking Committee, talking about additional regulations. So we'll stay on top of all of that coming up. This is Bloomberg. Let's get some company news right now with Lisa Mateo.
Thanks, Paul. McDonald's is expanding its footprint big time. The fast food chain says it's looking to hit 50,000 locations worldwide by 2027. That's the fastest expansion in its history. McDonald's currently has more than 41,000 restaurants and already committed to opening an extra 2,000 by the end of this year. McDonald's shares right now, they're down just a fraction. And to the airlines now, where Delta has backed its guidance for the fourth quarter and a full year. We get the breakdown from Bloomberg's Emily Grafeo.
The forecast, they see fourth quarter total revenue up 9% to 12% year over year, full year revenue up about 20% year over year, and adjusted EPS $6 to $6.25. The stock, though, 21 buys and only 1 hold, 0 sells, according to the Bloomberg estimates of analysts.
And shares right now, they're up about 4.5%. In other earnings news, Rent the Runway shares, well, they're lower. They are down about 22%. And this is after the clothing retail rental company reported revenue and active subscribers for the third quarter that missed estimates. Amazon may be gearing up for a Chinese fast fashion upstart, Shein. Amazon will be lowering its fees for third-party merchants that sell inexpensive clothing on its site. Now, the current 17% seller fees, that will drop in January to 5% for items costing less than $15 and 10% for clothes that sell for $15 to $20. Right now, Amazon is down about 1%. And Chinese EV maker NIO plans to spin off its battery manufacturing business, possibly before the end of the year. That's according to Reuters. A valuation will be decided later. I'm Lisa Mateo.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
All right, not a lot of movement here in these markets. S&P is pretty much unchanged, as are the Dow and the NASDAQ. Yields in a little bit, off in about 5 basis points, now to 4.11% on your 10-year WTI crude oil. That's the story of the day, off 4%. When now it's $69.40, below that $70 support there. Gold, a little bit higher, $2,030 per ounce. Bitcoin steady here after a big run up. It's now 43,800. So some big moves there in the marketplace, not so much in the equities. Right now, let's head down to Washington, D.C. Nancy Lyons has our World and National News.
Thanks, Paul. After serving the same California district for 17 years, former House Speaker Kevin McCarthy says he's leaving the House. He made the announcement in a video posted on social media.
It is time to pursue my passion in a new arena. While I'll be departing the House at the end of this year, I will never, ever give up fighting for this country that I love so much.
McCarthy's exit comes after he was ousted from his leadership position in an historic vote back in October. In an op-ed in the Wall Street Journal, McCarthy said he would continue to recruit others to run for office, but he did not say what his exact next steps would be. His departure at the end of the year means Republicans will see their majority shrink even further. They're already dealing with the loss of former Congressman George Santos, who was expelled over ethics concerns. While there are growing concerns about the humanitarian crisis in Gaza, Israel's widening air and ground offensive in southern Gaza is again displacing thousands of Palestinians who had fled to that region on Israel's advice. As for the fight itself, Israel Defense Forces spokesman Major Doron Spielman says they're focusing on Khan Yunis, seen as the last bastion for Hamas fighters.
Khan Yunis is really the hub of terror. If we think of any organization, like ISIS and Mosul, this is the Mosul of the Gaza Strip.
Spielman says what makes the fight in Khan Yunis so difficult is that Hamas